All right, yo, what's up for everyone watching this on the YouTube replay? We're going to be going over dividend stocks in this video, specifically ones with some higher dividend yields, and I want to give you some full analysis on these. I want to show you what makes a dividend stock have a safe dividend. I'm just going to show you how to tell if a company has a safe high dividend yield. Like a UPS, in my opinion, does not have a safe dividend yield, and it'll most likely have to get cut in the next year. Well, almost certainly, in my opinion, but I'm going to go over some dividend stocks that I think are quite attractive with some pretty high yields. So, this first stock is ticker symbol GSL. This company has a 5.5% dividend yield. And check out that payout ratio in the middle there. They're not lying. They only have a 17% payout ratio for a 5.5% dividend yield. This is one of those shipping companies. They ship a bunch of, containers over the sea and stuff. And the stock has done great. It's actually nearly at an all-time high. The stock's at an all-time high, and the stock chart doesn't even include the reinvested dividend. But here's how we can tell if this 5.5% dividend is actually safe on this company. In my opinion, it totally is. So check out their net income right here, their bottom line. They net 95 to 100 million of net income a quarter. So let's go see how much a dividend costs. So they're easily doing, call it 95 mil of net income a quarter. Well, they pay a dividend. That 5.5% dividend only cost, and this is the number exactly, $21 million. So this company certainly, in my opinion, has a very safe dividend. It only costs $21 million. So yeah, hey, what up, Plasma and Tommy? So yeah, if we go to this company's website right here, one other thing to be aware of, this company doesn't pay taxes because of where they're located. But yeah, like I said, it's one of those shipping container companies. They benefit from supply chain issues. This is like the way more better purchase than a Zim, in my opinion. A lot of people hype up ticker symbol ZIM. They also have a high dividend yield, but that one's not nearly as quality. So here's Zim right here, pretty much, not at all-time highs, kind of like that other company is. And this company's net income is way more choppy. Check this out. Like, it consistently is sometimes negative. So I always will recommend GSL over that one, and the stock price, you'll get some good stock price appreciation potentially as well. So yeah, look how more consistent this company's net income is. I mean, they're even on a bad year, like 67 million well covers the and look at this, we can go all back to 2021. They always make over 50 to like 100 mil of net income a quarter, and it's only gotten better this past year. So that's a cool one. Or actually, we can look at the net income to common holders. There's an insider taking a little bit of profits here. But anyway, dividend super safe in my opinion. That's the first stock if you're looking for a bit of a higher yielder. So yeah, that's ticker symbol GSL, the better play than Zim, in my opinion. So next up, the other company I want to go over is actually ticker symbol let's go over this one. MDLZ. This is Mondelez. They own so many great brands like Toblerone, Oreo, Cadbury. There's partnerships. They have partnerships with McDonald's as well. They're just one of the food companies that are being hit. Just like if you look at Pepsi, Hershey, a lot of these food names, General Mills, the charts look very similar. But this one, in my opinion, is one of the more quality buys if I was going to buy the dip on a food stock right now. They traded a 19 forward PE. The market cap is 71 billion. I actually want to pull up their website. Oh, and look at this yield, a 3.5% dividend yield, safe 50% payout ratio. So yeah, if we go to Mondelez right here, I guess, they're trying to get my cookies right here. But I want to see their like family of brands. Normally they show that. I guess they own Triscuit, but I want to find their just, maybe we won't be able to find it. So actually, here's the investor website. You know what? Oh, well, they own a bunch of popular food brands like Oreo, Chips Ahoy, and that kind of stuff. So yeah, biscuits and baked goods are 49% of their revenue. Then chocolate, like a lot of people's favorite chocolate is Toblerone. This one's actually done great. It's at a record of 10% year over year, after grew 8%, after grew 15. I guess they sell gum and candy as well. That one's kind of a flat grower. But it's cheese and groceries, so they're a grocery store. Baked biscuits, that's up 4% year over year. So anyway, if we go to their bottom line, they're easily making every quarter around like 500 million to a billion. And like that one quarter Q4 is really real. They really did make like 1.7 billion net income. So let's go see how much a dividend costs. So they're easily making, if we average it out here, like, I don't know, 800 mil of net income a quarter, maybe a little more. Let's see, the dividend cost 609 million. And why is the cost of the dividend going down? Because they're also doing a lot of share buybacks since they have a lot of room on top of that. So this company doing buybacks, 3.5% dividend, and they have some great brands. You just want to I think the risk reward is pretty good to buy this one. It's at a 19 PE, a lot of great names there. So yeah, that's the next dividend stock. Hey, what up, Brian? Good to see you. You don't want their cookies? Oh yeah, literal cookie. That's funny. That's funny. So here's actually a REIT. This is ticker symbol CTRE. It has the best balance sheet for a REIT I've ever seen. I've looked at all the REITs out there that exist, like literally. And this one, if you buy it right now, even at its current price, you're going to get 3.5% of your money back just in a dividend every year. And that dividend is super safe. And why is the dividend kind of abnormally high? That's because this one's a REIT. They kind of have to, by law, pay out 90% of their taxable income, and they've had great stock price appreciation, but let's judge them off their financials and the fundamentals, and this looks incredible. The revenue growth is some of the best I've seen. It's up 71% after it grew 38%, and this is a triple net lease hospital kind of senior housing REIT. Incredible net margins of 55%. And you really look at the revenue, it's 132 and they netted 75 mil. You really don't look at the net income for REITs because it doesn't include the depreciation and the amortization. So you really look at the core FFO, which is this number right here. So that's what you do a dividend payout ratio of. But even if we don't give them the benefit of the doubt and just do a dividend payout ratio off their net income, they made 75 mil in net income, and look at this fortress balance sheet. I mean, so incredible. The assets are growing, liabilities are staying the same, but let's go see how much the dividend costs. You should use this number. So they really made 100 mil, and let's go see how much the dividend costs from that. Sorry, I guess there we go. Dividend cost 67 million in the most recent quarter, so they can easily afford the dividend. Super great balance sheet, and it's in a bit of a more growthy sector right now. These senior housing facilities, they own some great assets. I made a video about them a long time ago. Actually, let me go back to them real quick. I think we go to the comments right here. Yeah, I made it a long time ago. Well, actually, not that long ago. I made a video going over these REITs right here, full more analysis if you want to go to one of my previous videos. What do you think about SoFi? Hey, we'll get to SoFi very shortly. Ryan said Calm will be losing money shortly. Egg farms are under $1, which isn't profitable. Let's actually look at Calmain right here. This company I do own, and it's actually one of the dividend stocks I want to go over in this video. For the fundamentals are so great on this one, but they're a commodity stock. They literally have the largest market share for chicken eggs in the US. That's all they do. They just sell chicken eggs, pure commodity, and the price has been very volatile. I am down on this company. I'm down 9% on this company, so not too great on this one. But let me tell you why. This one might be a decent risk to reward to buy now. Not a super great risk to reward, because if we look at this forward PE, they're at a 20 forward PE, which is a little expensive. But when we do an X cash PE multiple, let me show you a few things I love about this company. Check out the market cap in the top right. They're worth $3.5 billion. That's how much the whole company is worth. And check out their balance sheet. They actually have 1.14 billion in cash and no debt. So they have over 20 to 25% of the entire company of what you're paying is just their net cash on hand. But yeah, check this out. As we know, chicken eggs prices are starting to normalize. So this is tough comps, obviously, but revenue's down 19% year over year, but they still made 102 mil of net income. This company actually changes their dividend every quarter. They have a rule where they pay out 30% of the net income they make. So if we look at the dividend payouts, it changes every quarter. But yeah, currently they have a 11.7% dividend yield, and and if we look at the payout ratio based off the last full year, it's a 27%, but obviously that changes. So anyway, yeah, conventional shell egg sales, specialty egg sales, prepared food. Yeah, they're really getting a prepared food. So that revenue is like great, like new revenue stream driver. They did beat on EPS this quarter. They beat on net income and on EBIT. So the margins are actually holding up stronger than they thought. So anyway, the next time there's a bird flu or burning of egg plants, whatever, this is your way to really benefit from that. Again, pure commodity. You don't want to have these commodity stocks as like meaningful size positions in your portfolio. So that's another one that I do own. I am pretty down bad on them. So this next stock, and hey, then we'll get to some of y'all's stocks. Yeah, Iron Mountain. Let's actually check this one out. This is Iron Mountain right here. I do own this one as well. A lot of the interest rate sensitive stocks have been booming. Where's Iron Mountain? So yeah, Iron Mountain right here. So they're a great dividend payer. This is another REIT, and this is specifically a data center REIT. And they have a rule where they keep their dividend payout ratio in the mid 60%. That's what they always target, and it's always been around there. So you get a 3.44% dividend. It's actually higher than that. Actually, I think the yield, a 3.87, yeah. So they have a well, basically call it a 4% dividend yield because they're going to raise it. So they have a 4% dividend yield. What's really been booming is their data center business. Check out these year-over-year growth rates. This is what you want to see. It's up 33%, after grew 20, after grew 27, after grew 30. So it's just been literally hits a new record every year, every quarter. Then they have this other corporate and other. Check out that one's also at a new record this quarter, up 46%, after grew 85%. So that's what the kind of growth you want to see. Again, you don't look at net income for REITs, especially this one, because it doesn't include the depreciation and the amortization of these real estate assets. So you always look at the CFO, the core FFO, the AFFO, which is basically this number down here. So they're making on average, call it, some quarters it's really good, but let's just say 200 or 300 million a quarter. So they're making 300 million a quarter. Let's go see how much a dividend costs. So it costs 231 million. So really safe dividend there. And if you go to their website, like, there's so much future growth potential on this one. They've actually been one of the best performing REITs. This doesn't even include their dividend. This stock looks even better. Look at the stock price appreciation that it had. I mean, it just didn't go down because it's in the it's so growthy, and the data center business is booming. So yeah, that's why I picked up 4 shares of this one. I just like the growth. I like the numbers of what I've seen there. So yeah, that's Iron Mountain. Wait, is there any news around this one recently? Nope, not really. So that's a triple net lease one. So yeah, next up, I want to go over AbbVie really quickly. Yo, what up, Arthur? What's your favorite high potential stocks for the long term? Hey, we'll get into that in a second here. I think Microsoft is great. Monkey D. Luffy, no way. I really appreciate that. Why would people do that for nearly 4%, which gets eaten by inflation? So we're going over stocks specifically that have high dividend yields, but also will give you stock price appreciation. AbbVie is actually a great example. Let me go over AbbVie real quick. And someone said, what app is this? It's in the link tree in my bio, very first link there, app, a broker called Moomoo. So here's a stock that has a 3% dividend. Again, it's actually a little higher than this because they just wrote their dividend. They have like a 3.1% dividend yield. But I think on top of this stock will give you 3 to 4% in stock price appreciation every year for a total return of around 8% with AbbVie. And let me show you why I think that. If we look at the forward PE on this one, they had a one-time adjustment from, they had a schizophrenia prescription that had made their net income tank, but it was a one-time adjustment. If we go to their forward PE, they're at a 26 forward PE, which is pretty fair. That's not a crazy forward valuation, 26. And what does this company do? They sell a bunch of different prescriptions. Like Skyrizi, for example, has been growing like a beast. And this is why I think they're going to continue to give 3 to 4% in stock price appreciation on top of that 3% dividend. So this revenue is up 46% year over year, after grew 50, after grew 52, after grew 85. I mean, it just hits a new record every year, every quarter. This is the trend of what you want to see. And I'll tell you, that's just one of their prescriptions. Like, let's go to their next biggest one, which is 14% of the business, Rinvoq, or I don't know how you pronounce it, but that's up 35%. After grew 45, after grew 59, after grew 56. I mean, this is the kind of growth that you want to see, and that's why I trust this one. Like Botox Therapeutics, whatever this is, it's almost at $1 billion for the first time ever, and it just all in the middle here, just positive year-over-year comps. So that's what I like about AbbVie at a 26 forward PE, a 3.1% dividend yield, and on my opinion, you should get 3 to 4% stock price appreciation. I'm totally biased because I did just buy this one, I'm up 0.5%, but I got 3 shares of AbbVie now. That's my healthcare play. If you want exposure to some of these prescriptions, I think there's some news about them doing acquisitions, or Healthcare Canada approves AbbVie's. All right. Well, anyway. I wanted to pull up that revised EPS right there. So yeah, AbbVie gave a full year EPS outlook. Actually, let me pull that up really quickly. Where is this? Q4 EPS guidance of 265. Where's full year EPS revised to $9.90 to $9.94. So basically call it $10 of EPS, and it's a $220 stock. So that's actually a 22 PE. Simple math. If they make $10 of earnings, it's a $220 stock. 22 PE, forward PE potentially. Anywho, that's AbbVie right there. Oh, hey, you know what? I wasn't going to talk about Clear Secure, but that's another kind of higher yielder. Let's actually check out. Okay, it's actually not too high of a yield, a 1.4% dividend yield. This one is that airport company. Well, not actually. They're the digital scanner, like that lets you skip the lines in the airports. If you've heard of Clear Secure before, They just make good money, in my opinion. We can see the revenue is just up and to the right, hits a new record every year, every quarter, and they have great net income as well. And this was a one-time adjustment. You really look at the operating profit because that excludes that little one-time adjustment. So the year-over-year comp, this is what you really want to look at. This is the before-tax numbers, so you basically will remove another 15%. But they just had a record profitable quarter of 52 million. They netted on that 45 million, so they made 45 million of net income just this quarter. Let's go see how much the dividend cost exactly. That's what we like to do here. The dividend cost literally $12 million on the very bottom left. If you're wondering, hey, then why in the middle does it say it cost $37 million that one quarter? Because they frequently do special dividends. You rarely see that with companies. If you look at like the fourth most recent payment, they did on top of their normal 12-cent dividend, they did a 27-cent special dividend because they have so much extra money, they don't know what to do with it. So anyway, that's kind of a cool thing about Clear Secure. They also do buybacks. I should have shown that too. But anywho, they're a little expensive at a 31 forward PE, but I collect a nice little dividends with that one. Ooh, Caterpillar. You know, that's one of the stocks that have been booming recently. A lot of infrastructure stocks have been booming, like a United Rentals, a John Deere, a Caterpillar. And Caterpillar, if I own this stock, and check out how good it's done. It's at an all-time high. If I own this one, I would not trim or sell this company because in my opinion, I think it's going to continue to climb higher. Check this out. The forward PE is a 30, so it is kind of like the risk reward isn't great buying it here, but even if you buy the stock right now, you get a 1% dividend. They have a very safe 25% payout ratio. You know, the valuation, the forward PE is expensive because the stock has gone up so much, you know. So a 30 forward PE, they're in energy transportation. They're very nicely diversified. So a lot of their customers are energy and transportation. Then they're in the construction, you know, these huge construction Caterpillar, machines that we see. And the resources, so like people trying to get resources out of the ground use them. So let's see. Caterpillar expands NVIDIA partnership to integrate AI technologies across operations. Caterpillar launches Cat AI Assistant. So it looks like they're getting into AI or stuff like that. Anywho, they print money easily over 2 to 3 billion of after-tax net income a quarter. And it is down year over year, but is expected a massive rebound. They had a massive beat this quarter specifically on earnings. Check out the orange line. That's kind of what the analysts expected. They expected 16.7. They did 17.6, and the EPS they expected was 438. They did 488, and on the EBIT, so not even like this was some one-time adjustment. This was really real. Like the earnings before interest taxes had a big beat. So anyway, Caterpillar's a beast, just like United Rentals. Oh, I almost want to go over United Rentals right there. It's such a good stock. And my bad if I'm a little behind on the chat here. I want to go over strictly some dividend stocks because I'm gonna upload this as a video later. And then right after this, we'll get into some of y'all stocks. So I just want to go over United Rentals really quickly. Now, this one has had a massive rebound the past couple of days, but I put this one on your watch list if you're just looking for a very shareholder-friendly company. If we go to their net income, they're easily actually a better way to look at this is the EPS. So the dividend is $1.79. Here's another simple way to do a dividend payout ratio. So the dividend is $1.79 a quarter. And here's what they make in net income a quarter in terms of EPS, $10.90. I mean, on average, this company's always making like basically $9 to $10 of EPS a quarter. That's net income per share. There's another cool metric called the free cash flow per share. And check this out. They make $18 to $20 of free cash flow per share a quarter. And the dividend only cost $1.79, added this 18, added this $10. So if we go to their net income, they're easily making like 700 mil of net income a quarter. How much does the dividend cost? Literally only $115 million, only $100 million. And since they have so much leftover money, my favorite part about this company is the share buybacks. Check this out at the bottom here. They did 600 million of buybacks just in the most recent quarter, a record buyback. They're always buying back 400 to 600 million dollars of like their own stock. And they've done that for all of eternity. You know, even back to 2021, they spent hundreds of millions of buybacks. So if we go to the total common shares outstanding, like if we just go back to 2021, there were 72 million shares. You kind of see that there were 72 million shares. Now there's only 63 million. And whenever they buy back their own shares, that makes the EPS go up, gives you more ownership in the company, makes the dividend cost go down. So this just has the DNA of a multi-bagger, in my opinion. At a 23 forward PE, it's not crazy expensive. Like it could stretch up to like a 25, a 28 forward PE, in my opinion. So that's why I do own United Rentals. I am biased, but yeah, these dividend stocks, it's like the dividend stocks are working this year, which is crazy. Like Carlisle also, they're up 9% year to date. Our Cavco, this is a home factory built home manufacturer. They're up 13% year to date to an all-time high. I mean, these dividend. Oh, and if you just look at like all the anyway. Okay, let's see here. Let's look at some more stocks. Let's look at y'all stock. Nick said Visa stock. You know what? Let's go over Visa because this is a great one, in my opinion, one you can't bet against. And you know who actually owns Visa is Nancy Pelosi. If we go to the Nancy Pelosi portfolio right here, actually, let me pull this up right here. I think I had it. The Nancy Pelosi portfolio. Here's kind of how her portfolio has done. But yeah, one of the stocks she owns is Visa. This is another great stock to buy, never sell. I think if you buy the stock even right now, you should still get S&P 500 type returns, like 8% of your money back a year, because they're so growthy. But yeah, the forward PE is like, here's why. They're not expensive on a forward PE. They're trading at 27 times next year's PE. That's super fair, in my opinion. If we go to their net income, this is what's crazy. They're easily making 4.5 to 5 billion of after-tax net income a quarter. And what are they doing with 5 billion of after-tax net income a quarter? Well, the dividend only cost 1.15 billion, but the buybacks are the winner here at the top. This is why the stock doesn't go down. They do 4 to 5 billion of buybacks a quarter. That's the best part about Visa. They're so shareholder friendly. Jonas said, what app is they using and is it free? Yeah, hey, this is a free brokerage right here. It's where you buy stocks on, but yeah, you could use it just for analysis. If you want to get this brokerage I'm on, it's actually in the link tree in my bio, very first link there, broker called Moomoo. It is an affiliate link too, so if you go and like deposit $100, we'll both get some free stocks. But yeah, I love this app. SoFi, oh yeah, let's get to SoFi real quickly. Then we'll look at some more. For everyone on the YouTube stream, re-say your stocks and we'll check them out right here. Sorry if I missed some. Does Clear Secure directly benefit from increased travel? Yeah, if they're going to the airports, for sure. Was scrolling through random stuff and came across this live. Hey, what up, Sahil? Good to see you, man. Hope you're having a great day. Great Sunday. We actually stream every day if you want to hit the follow button. AGNC, hey, that one I think is a bit of a dividend trap. Well, that one you buy to maximize your income. We actually will check out AGNC probably. And here's SoFi though. This one is one I do own. I'm totally biased on this one. This one doesn't pay a dividend, but SoFi makes up for it in terms of stock price appreciation. You know, they could pay a dividend, but they certainly shouldn't right now. But yeah, here's why I think this is a great growth name. And the financials we're about to look at explain why this stock has done so good. Check this out. If we go right here to their financial services business, this is what's unbelievable. This is what justifies the momentum and sustains it. The revenues growth is crazy. The financial services is up 76% year over year. After grew 101, after grew 222, after grew 260. Like the growth is insane, and it's so growthy that not even the analyst expected this. We can see what the analysts expect. It's that orange line right here. Every quarter, for history, they always beat. They beat on revenue. They beat on net income. They beat on EBITDA. So that's why I think people are really starting to take SoFi serious. They're easily making 100 mil plus of after-tax net income a quarter. The revenue growth is there. So they're a nice fintech name. Kind of like the picks and shovels play. It's a great one in my opinion. So AGNC, this one is one you buy to maximize your dividend income. I think this is a mortgage REIT. We can kind of see how this one's done. You know, it's a lower price than they were in 2008. But it has had a little bounce. Check that out the past couple weeks here. Let's check this out actually. So they have been missing on expectations. So the revenue is a bit like choppy here. Like that looks weird. Here's the cash from operating activities. This is kind of the metric you would want to look at. And hey, it has actually really recovered. That's great news. The revenue does look choppy. But here's why people like this one. If you look at the dividend, you get a 12.6% dividend yield there. You should get You should get the 12% dividend, and then you're probably not going to get any stock price appreciation, and most likely the stock will go down. I don't know. Let's go see how much the dividend costs. So the dividend cost exactly every quarter. If we look at, so the dividend cost $416 million. And notice the stock is, why is the cost of the dividend going up? Why is the cost of the dividend going up? Well, if we look two metrics above this, normally when we go to net common stock issuance, we always see this negative. We always look at companies that buy back their own stock, but this company is issuing every quarter a couple $100 million of their stock, and maybe they're getting good returns on it. Who knows? But yeah, the dividend costs $416 million, and they can't afford that from the cash from operations. And they did make that in net income this quarter, but all the other quarters, when you average it out, like it's too inconsistent for me to fully trust that one. I wouldn't keep too much money in that one. But they've had done really good the past couple weeks here. Okay. Hey, thanks, Brian Paul. Once Warner Bros. Deal goes through and concerns over, Netflix can bounce back. Not only that, Netflix don't own major film studio, so it benefits. So let's actually cover Netflix real quick. NFLX, this one's kind of cheap right here. Ooh, NU's a great stock. Hey, remind me to get to that one a little later. And sorry if I missed some of these, like DAO. I want to check that one out too. So here's Netflix. This one is not crazy expensive, when we forget about all the Warner Bros. Discovery news, because right now, like obviously they're trying to be acquired by Netflix and Paramount, and Paramount, bid 108 billion versus Netflix 82 billion. And if Netflix has to pay more, that's even more, it'll be even more decretive to their EPS. But anyway, when we ignore all that news, we're left with the great business at a great valuation, a 28 forward PE. That's pretty fair. I know it's probably one stock you buy if you want it as 5% of your portfolio. You make it 1% today. You nibble on this one. You dollar cost average. Don't full size position your portfolio in this one yet. But it's a great business model. A lot of people would cancel their Netflix subscription last. They easily make in after tax net income. After they pay hundreds of millions of taxes every quarter, $2.5 to $3 billion. And year over year, it's all green. It's all growth from the previous, or all grown from the previous year. And same with the FCF, which is free cash flow. They're easily doing over $2 billion easily of free cash flow quarter. So you're left with a good subscription business at a 28 forward PE. You can see they got 300 million premium subscribers. They make $11.69 per month per user. I think that's kind of a cool metric here. Netflix expands WWE partnership to host premium live events and library. So yeah, that could be cool. Oh, who's actually done really good? Another kind of beneficiary here is TKO Group. It's a great ticker symbol for them. Ticker symbol TKO is the one that owns the WWE. So look, right here, 40% of the revenue is WWE. They also own the UFC. So they basically license out the streaming rights to Netflix. So this company actually has crazy good margins. And look at the net income they're making now. For the past 4 quarters, they're making 100 to 200 million net income a quarter. What's their actual net margin now? So yeah, they do finally positive margin, and they just acquired IMG Worldwide. So anyway, that's kind of another cool one. And wait, the forward PE on that one, it's also really cheap, I think. A 22 forward PE. Yeah, they're expected so much growth. So that's UFC, WWE. Okay. NU. Okay, yeah. NU stock. This is actually a crypto bank out of Brazil. And that's actually where crypto is really popular and where they actually use crypto for like transactional purposes. But if we just judge this company off their financials, it's flawless. I mean, it's incredible. All the revenue does come from Brazil, or 92% is Brazil. Mexico's 5%. So, US is nothing. They are applying for a US banking charter right now. But if we judge them off their numbers, this is incredible. And this is real. Like, look at the net income. It's 780 million this quarter. After it's up 42%, after grew 82, after grew 222, after it used to be negative. This is a great company with great financials at a great valuation. I think it's a great way to get exposure to crypto. 21 forward PE, because they have a lot of growth ahead. Like, let's actually see the EPS expectations. Yeah, look at that. It's going to go from 11 cents to 18. That's a big increase. So anyway, NU's a great stock. I can see why they're at all-time highs. They have great fundamentals. So yeah, that's they don't pay a dividend, but they make up for it in terms of appreciation in the stock price. Oh, so I saw some comments about pins and hey, what's the ticker symbol for Simmons? I think they're like a really weird ticker. Um, So here's Pinterest. It's actually a debt-free company. Ooh, we got to get to BAER. Hey, what up, Johnny? Teradyne, they're a great robotics play. Rivian, ooh, that one interesting. And Mo, hey, actually, let's look at Mo after this since we're on dividends. Yeah. So here's Pinterest. This is a debt-free kind of social media app. What I love about them is their fortress balance sheet. The fact that they have $2.7 billion of cash. And what's the market cap? 18 billion. So well over, 10, like 13% of the market cap is just their net cash on hand. But they have a they had some one-time adjustments. If we go to their net income down here, it says this one quarter they made 1.85 billion in net income. They only made 260 million. So that makes their current PE ratio look really cheap. If we look at their current PE, it says a 9.5. But when we exclude that and kind of look at the forward PE, it's a 39. So it's not some extremely cheap company anymore. 39 forward PE. So that's why it kind of is fairly valued at this price. I wouldn't consider this like a steal of a deal right now, but here's a great metric we get. This is their monthly active users. They have 600 million monthly active users, up from 537 the same time last year. And they have so much cash. So they have $1.7 billion of cash. Or no. $2.6 billion of cash. So they have $2.6 billion of cash that earns them interest every quarter of $25 to $28 million. And that just goes straight to their bottom line. It's actually why their operating profit, the before tax, before interest number is 58 million, but the after tax number is higher at 92 million because it doesn't include the interest. So anyway, that interest just adds money to their bottom line. Any good cybersecurity plays? Here's an ETF for you if you like cybersecurity. Check out ticker symbol HACK right here. It's actually done really good, but it just owns a bunch of cybersecurity names. And my favorite cybersecurity name, Cisco's a good one. Palo Alto Networks, CrowdStrike, Fortinet too. Yeah, Fortinet. Palo Alto Network's got to be the most quality pick, the best cybersecurity name, right? Like CrowdStrike and Palo Alto are the super best quality, but they're the super most expensive. Cisco's great because they acquired Splunk and they're at a 25 forward PE plus a 2.5% yield. Fortinet has great. Let's look at Fortinet really quickly. Oh, what was that stock I wanted to say? Ah, there was a stock I wanted to look at, but Mo, it was Mo. We got to look at Mo after this. But yeah, Fortinet right here, a subscription model company. 40% of the revenue is their cybersecurity subscription, and this is the growth you want to see. Every year it just hits a new record, a new all-time high. And if we go to their net income, they're printing every quarter 500, 400 million of after-tax net income. Great numbers on Fortinet. So let's get to Mo right here. This one is another one you kind of buy to maximize your dividend income. The stock is the same price that it was in 2016. So you bought the stock in 2016. It's the same price that it is today. But they paid you every single year a qualified 7% dividend. And maybe if you bought it even lower, you got like a 9 or 10% dividend every year in qualified dividend. So yeah, they have a 7.12% dividend yield and a safe 62% payout ratio. Let's go do the math for ourselves to see if the dividend payout ratio really is safe. So this quarter they made 2.3 billion. I know they had a one-time adjustment right here. It says they only made 1 billion, but they really right around their normal 2+ billion. If we zoom out, they're always making over 2 billion net income a quarter. So they made $2.38 billion exactly the past 2 quarters. Let's go see how much the dividend cost. The dividend cost at the very top here, only 1.72 billion. So as long as they're making over 1.72 billion a quarter, they can afford the dividend, and they can certainly afford the dividend. Since they have so much leftover money, they're even doing buybacks. Check that out. They're doing a couple hundred million of buybacks at the top here. 2024, they had a big acquisition or big buyback. They have a bunch of positions in smaller stocks. Like I think they have a big, they're down bad, super bad on this investment, but ticker symbol CRON and a couple of, Altria is the largest shareholder. They own 40% of all the shares. What's the Anheuser-Busch? I don't know the ticker symbol, but I think Mo is one of the largest shareholders there. Okay. Johnny's Pinterest worth 18 billion. Hey, what up, Interactive? I'm so behind on the chat here. I really do apologize. I'm missing so many stocks here. What's this one? CTAS. Let's check this one out. Cintas right here. I haven't heard of this one. Oh, Simmons. Okay, yeah, Simmons after this. Simmons is a nice AI kind of electrical infrastructure play. We have like a Simmons like switchgear outside, but anyway, on our house. So anyway, here's Cintas right here. 37 forward PE. The stock has done great since 2019. Check out that uptrend. Let's see what this company actually does. So uniform rental and facility service. So maybe they're like a United Rentals kind of. It's up 8% after grew 7.5 after grew 8%. So that's some consistent growth, single digit growth. They're also in first aid and safety. That's kind of nichey. I like that. That's up 15% after grew 12 after 11. So that's also seen some great growth. Yeah, whoa, look at that. Their bottom line after tax net income every quarter, after they pay 150 million of taxes, they're always making 400 to 500 million of after tax net income. And it's only green year over year comps. They bought back over 1% of the company. You get a dividend too. So it's a nice dividend growth company. Yeah, I like that one. Is that beating on expectations too? So yeah, they beat on EPS, they beat on revenue, and they beat on EBIT, especially this quarter. So yeah, triple beat company. They might still be slightly expensive, but what app do you use, bro? Is it available on Apple? Yeah, hey, I'm on an Apple device. This is a brokerage right here where you buy stocks on. It's my favorite app. It's in the link tree in my bio, very first link there if you want to get it with my affiliate link. But yeah, you can type it into Google, a brokerage called Moomoo. Yeah, first link in the link tree in my bio. Let's see. Favorite moonshot potential stock? I don't really know, man. The market's at all-time highs right now, but these are some of my favorite picks right now. Microsoft's a steal of a deal. Tradeweb, Progressive, if you like an insurance company, I'm down on this one. I bought them at 246. They're at 215. Um, but yeah. Uh Nothing too crazy. Watch the very beginning of the stream. This is the most interesting dividend stock I think out there. Now that there's a lot more people in here, let me go over GSO really quickly. If you're looking for a high yielding stock that still gives you stock price appreciation, or check out GSL. It's one of those shipping companies, but look at the dividend. You get a 5.5% dividend, and that payout ratio is correct. They only have a 17% payout ratio for the 5.5% dividend, and the valuation's cheap. It's a 3.6 forward PE. You can't believe it. But if we go to their after-tax net income right here, it's so consistent. We can zoom out for eternity. They're always making, even back to 2021, 60 to 100 million of net income a quarter. And it's especially been great the past 4 quarters. It's had great year-over-year comps. But let's go do a dividend payout ratio. Let's go see how safe this 5.5% dividend is. So they're easily making, we'll call it 95 mil in net income a quarter. Let's go see how much the dividend costs. Their 5.5% dividend only cost at the top here $21 million. So they really do have a 20% payout ratio for a 5.5% dividend yield. I think it's the favorite shipping play. Again, if you're wondering what does this company do, they're one of those shipping cargo companies. Where they ship a bunch of cargo containers, but they make a crazy net income every quarter. Like look at their net margin. Actually, their net margin is a 49%. So look at this. Their total revenue is 192 mil, and on this 192 mil, they net 95 mil. But another reason why are their margins so high? It's because they're actually headquartered in Greece. They're headquartered in Greece, and this is all in US dollars too. So don't worry. But they actually don't have to pay basically any taxes. They don't pay any taxes, so they just keep so much, and that's why this stock is pretty much at an all-time high right now. And it'll probably just continue to, that's ticker symbol GSL right there. Yeah, check out this stock on the dividend reinvested chart. It's actually been a crazy good performer. So yeah, it's a bit of a higher yielding one. It's a niche one, actually has a 7% dividend, a 7% dividend. So that's crazy. Okay. And MU, I also wanted to lock in some profits so I could buy VRT. Oh yeah, MU is a great one. Hey, what up, OLP Papa? Good to see you, man. And Josh. Oh, yeah, Simmons. Let's check out Simmons right here. I just logged out of my freaking account. Hey, yeah, if you want to get this app I'm on, it's in the link. Actually, I have to disconnect this really quickly because it won't let me log in. But give me just 10 seconds here. If you want to get this brokerage, I'm on Linktree in my bio, very first link there. I actually clicked the log out button, so no one, I didn't do anything wrong there. Come on, send me the text already. Uh-oh. It didn't. Oh my goodness. I have to manually type this in. 9. Okay. We're back into the account. We're back in. Now I just got a screencast again. We fixed it. Oh my goodness. My bad. We got to look at Simmons Energy now. I don't know what I'm doing. Okay. All right, so Simmons Energy, let's type that in. So here's the ticker symbol, SIEGY. It's one of these kind of electrical infrastructure plays. They're at an all-time high, a crazy new all-time high. So yo, congrats if you own this company. The forward PE is super fair. A 24 PE, even at all-time highs, implies to me that this company still has the ability to stretch up to like a 20. In this environment, let's go check out the growth that they're going to have. This could stretch up to like a 28 forward PE and still, have good upside even at all-time highs. So yeah, Simmons Healthineers, smart infrastructure. Let's see how that's growing. I wonder, I know they're a European company. Okay, so let's actually do this all in euros. Let's convert this to USD just to get a better idea here. But the EPS growth is supposed to go from $5.48 to $11.15. So, and the revenue too is going to go from 20 to 23 billion. So it looks like there is a lot of growth expected here. Here's their bottom line in net income every quarter. They're easily doing sometimes, was that a real quarter? Okay, no, that wasn't a real quarter. That's why the forward PE is, or the current PE is so low, because they didn't actually make $4 billion, but they did make $2 billion that quarter. So they're easily doing $2.6 billion net income a quarter. Yeah, the cash flow is insane on there. I wonder if there's any news. There should be. There's not, but actually, I really like Simmons. I think you get a good dividend. Yeah, look at that, a 2% dividend. So it's another kind of higher yielding electrical infrastructure play at all-time highs. So nice. They do everything. It's like how Amazon has a bunch of stuff. Yeah, hey, they're pretty cool. Lopez says, thoughts on SMH right there. Let's check that one out, SMH. And should we check out FRO too? Let me know if you want me to give analysis on that one. So yeah, if you're looking for a semiconductor play, if you don't know which one to buy, check out ticker symbol SMH. I don't think any investor if they're a shareholder, is disappointed in the results that it's given. It basically just owns all of the AI plays. Because like if you don't know which one to buy, if you're like, I don't know where to buy NVIDIA or AMD or Broadcom, just buy this ETF right here. It diversifies you into all the good names and it gets you exposure to like Micron, which is like, there's a huge memory shortage right now. And basically, if you bought this ETF, you unknowingly got a huge benefit from it. Like look at Micron. It's actually led to a lot of the ETF's gains because NVIDIA's been flat. Like almost like this ETF has done better than NVIDIA because the other names are starting to pick up traction. Like I think ASML is close to an all-time high as well. Yeah, ASML is at an all-time high. That's your lithography play. So yeah, it's a great ETF. It's like a pure AI play. I certainly wouldn't buy it at all-time highs, but next time there's like a huge AI dip, that's when you might want to buy on a dip. Tough to buy them at all-time highs, but that's probably the ETF that'll just continue to hit newer all-time highs. We kind of made a little infrastructure watch list here. Quantum computing, I kind of the top quantum computing stocks are literally like a Honeywell, a Google, an IBM. I kind of stay away from the other quantum names. Here's a cool ETF if you're looking for one to maximize your dividend income. Let me check this out right here. MLP, or is it AMLP? It's MLPA. So check this out right here. This stock is one you buy to maximize your dividend income because it owns a bunch of MLPs. So you never want to buy these individually. If we look at this like ET, EPD, all these are MLPs. And what that means is they send you a K1 tax form. And that's why I like this ETF right here because it doesn't give you a K1 tax form and it just owns a bunch of MLPs. And check out how it's done. It's just been up and to the right. Now, and look at the dividend at the top here. They have a 7.7% dividend yield. The expense ratio is a little high, a 0.45, but that's because they handle all the K1 tax form stuff for you. So there's kind of a higher yielding ETF. You basically buy it for the 7.7% dividend yield. You get the 7% of your money back a year, and then you kind of hope for actually, you might not even get the 1% stock price appreciation. If we go back to this ETF on the non-dividend reinvested chart, like this stock is not done great, but that's because it's to maximize your income. DAO. Let's check out that one. DAO. And sorry if I'm behind you. There's so many stocks I'm missing here, and I'm so sorry. Do you like Webull stock right now? I do. But only to nibble on because they're actually pretty expensive. Hey, Jeff Mack, what's up, man? We'll check out Airbnb after this too. Heck yeah. Airbnb should be an interesting one. I've never heard of this company right here. Yeah, so this is a really smaller one. We'll kind of be quick here. They're only worth $1.4 billion, but the stock has had a massive, oh, it's a Chinese company. So I don't like the Chinese companies. Let's see. So yeah, all the revenue does come from China. Looks like some kind of learning service online marketing company. They're actually, look at that. Their online marketing revenue just hit a record 88 million. How about the learning services? So that's kind of been in a decline. So yeah, they're not making any profits. They're highly leveraged, twice as much liabilities as assets. Revenue's kind of flat. So nothing's really blowing me away here. Looks like the net income was negative. So I just be real careful with that one. But maybe there is some short-term good news. But I wouldn't probably have that one as a big size position. Okay. Do you mind doing AEM? What's this one? AEM. Am I bad if I'm missing some stocks here? Oh, Agnico. So this is one, I think they're a gold player. What? Okay, so yeah, they own a bunch of gold mines and rare earth mineral mines. And so it's kind of like a pseudo gold play. So if you like, it's kind of like gold with the yield. So you capture the upside of the gold commodity. And I think, yeah, you get a 1% dividend yield. And I bet this dividend's about to go up like crazy because if we go look at their net income, they made $1 billion of after-tax net income. After paying a couple hundred mil of taxes, they netted $1 billion in net income. And if we go to the EPS projections, it's literally good. There's still going to be triple-digit EPS growth. It's going to go from $1.62 to $3.13. And I bet they're even going to beat on these expectations. Revenue, too, everything's just up and to the right. So, yeah, this is a great one. It's like you get the upside. Actually, we should almost compare this stock right here. We can kind of overlay it versus gold. Gold is ticker symbol IAU. Let's see how it's done. So yeah, it's actually outperformed gold while paying a 1% dividend because I guess they own all these mines, and I like how diversified that it is, like Detour Lake. So anyway, there is a gold play for you. It's actually pretty good fundamentals. So I put GSO on my watch list. Hey, nice. They're a grease company. Pretty cool, like a shipping company if you're looking to maximize income. So let's check out Airbnb. They don't own any houses, but they collect a fee every time you book a house. And check out the forward PE in the top right. That's really, honestly, that's pretty fair. A 29 forward PE. Netflix is at a 28. Let's see, order quantity here. Nights and experiences book, it's at 133.6 million versus the same time last year, they did 122 million. So that's actually a nice increase year over year. So if we go to their net income, and this is real, like this quarter, they made 1.4 billion net income. That's after they paid 300 million of taxes. Like they really do make on average a great amount of net income. So, yeah, I wonder if there's any like news around this one. Weekly news. Airbnb receives upgrades from multiple brokerages on growth opportunities. Analysts highlighted opportunities in hotel supply, sponsored listings, along with projected revenue and earnings increases. But there's still regulatory issues. Anyway, pretty cool. Airbnb. Actually, look at that. Only 41% of their total revenue comes from the US. International has been a big growth driver for them. It's 58% of the revenue. Has it always been like that? No, it's actually grown faster, I guess, than the US. Pretty interesting. We can just kind of see their earnings here. So anyway, yeah, Airbnb is an interesting one at a not crazy expensive valuation. It's probably fairly valued at their current price. Could you do 3M? Yeah, is that just triple M right here? This is they've really recovered from their lawsuit payouts. This stock hasn't done great. 3M is lower than it was in 2017. So, it's kind of been flat for a while, but they had these these earplugs, and these earplugs gave the U.S. military the C word, or it got them super sick, we'll just say, and there's still like lawsuit payouts from that. Like that's why if we zoom out, let's actually see if we can find those. They had these massive payouts, and it was even worse than this because this still includes some of their net income. But yeah, they had to pay billions. But anyway, if we go, their net income's really consistent now, but it's kind of a single digit, kind of boring one. If we look at their top line revenue growth, the sales, the lifeblood of the company, it's up 3%. Last quarter was up 1, -1, 0.1, 0.3. So the kind of, and that's after it fell 25%. Whoa. So that's after, yeah. So this is the kind of thing. Let's look at this on an annual basis then. So yeah, look at this. The revenue is kind of lower than it was. It's 24 billion for the full year 2024. So kind of just a company that on average just now makes let me go to quarterly here. They make like 800 to $1 billion in net income a quarter. So let's go see what the dividend costs. So if they're doing like 800 mil to $1 billion in net income a quarter, the dividend cost 389 million. So as long as they're making over 389 million of net income a quarter, the dividend's safe, and they have been. They are a bit leveraged, though. I don't love this balance sheet. A bit of debt to pay. But yeah, you get a 1.75% dividend. What's the forward PE? A 20. So a 20 forward PE. That's probably that's not it's probably a fair, if not maybe slightly expensive on them. But hopefully that was somewhat helpful there. I do apologize. I know it probably wasn't too bullish on that one. Um Truth Seeker said evaluate SMFG. Sorry, I'm so behind here. I want to get to AMAT, Q2, IRM. Hey, we looked at Iron Mountain earlier. That's a data center REIT. I love that one. We might check him out again. So here's Sumi. It's one of the very first stocks we look at the beginning. Yo, by the way, if you want to support me, the only way to support me, because I sell nothing, I have no course, book, WhatsApp, I don't coach, I literally sell nothing. Only way to support me is subscribe to my YouTube channel. It's called Nathan Robert. It's also in the link tree in my bio, but you can just type into YouTube Nathan Robert. In the very beginning of the stream, I think you'll want to watch, because we go over the best high yielding dividend stocks, and I show you why I think they're still going to grow too. So anyway, let's keep going. Some of y'all stocks. This looks like some Japanese company. They're at an all-time high. I think it's like a Japanese bank. Let's convert the currency from Japanese yen to USD. If we go to their net income, yeah, they're printing money. Looks like they had a one-time adjustment that one quarter. But yeah, they're always making a record this quarter, 3.8 billion in net income. That probably explains why the stock is at an all-time high right now, because the net income's at a record all-time high. They pay a dividend, a 2.8% dividend. Yeah, so let's see what they do exactly. So yeah, they're headquartered in Japan. They provide financial services. So anyway, interesting there. Maybe it's a bank, some financial services company. I don't know. But they're at an all-time high. Kind of a lot of these banks are. Like if we look at just like a Goldman Sachs, like Goldman Sachs is a crazy new all-time high. Like these boring banks are doing great right now. Not just Goldman Sachs, but like a JP Morgan, another boring one with still a good dividend yield at an all-time high today, or basically at it. So some of these boring financial names are doing great. Like Visa does great, American Express. So, okay, let's check out AMAT right here. This is Applied Materials. So what's your take on AMD? I think AMD is still a little expensive. Honestly, I'd rather buy NVIDIA right now than AMD. And I say that as someone who doesn't own NVIDIA, and I do own AMDs. AMD just doesn't have a cheap valuation like NVIDIA does. But I also like AMD because they're smaller than NVIDIA, and there's more upside, because it's tough. It's almost impossible to double your money on NVIDIA, but you still should get like 8 to 10% of your money back a year buying NVIDIA now, I think. But let's check out Applied Materials. You can also buy the whole NVIDIA ecosystem like Applied Materials. This is another NVIDIA kind of beneficiary. Check it out. This one is literally at an all-time high right now. And the forward PE is a 32. I think AMD has like a 50 forward or a 60 forward PE. Yeah, AMAT, even at all-time highs, that's not crazy. A 32 forward PE for the AI space. So yeah, another big semiconductor name. Let's check out the EPS projections. They had a big beat. Look at that. So basic metric here, the orange lines what the analysts expect. They expect 6.67. They did 6.8. The earnings before interest, basic metric, they beat on that by a good margin every quarter. So they're beating on earnings every quarter. And check out the bottom line. This is their after-tax, net income right here. 1.8, 1.9 billion of net income a quarter. Let's see, do they have a dividend? Yeah, they have a 0.5% dividend yield. Let's see if there's any news around this one. Goldman Sachs raises a Applied Materials price target on strong demand for ETCH and disposition equipment. Tight DRAM and NAND markets expected to drive equipment orders in 2026 and 2027. So looks like there's a lot of tailwinds for their earnings. That's probably on top of that. So yeah, a lot of the revenue does come international. 30% China, 25% Taiwan, 20% Korea. So this is almost like a more international semiconductor play. Yeah, I didn't. Wow, the U.S. is only 10% of the revenue. So maybe there's some potential foreign growth. So let's see right here. BAER. So Bridger Aerospace, they are on my watch list. Let's see. It's a very small one, so you got to be really careful with these kind of names. If you look at the market cap in the top right, they're only worth 135 million. It's some people's cup of tea, getting these really small market caps. But let's see. So the whole company's worth 135 million. They're in the fire suppression business. Let's see how that's doing. So it looks like that just hit a record 52 mil. Aerial surveillance, maybe they're in like California watching for wildfires. The aerial surveillance revenue at 10 million, that's at a record revenue. And maintenance, repair, and overhaul, that's also grown nicely. So let's see, they are expected to lose net income, or they lose EPS the next 2 quarters. So do they have a forward PE? They do, a 14 forward PE. So the net income is a little choppy, but like they make all their net income that 1 quarter, then they lose money all the other quarters. So you kind of got to average it out here. But they net are like these year-over-year comps look great. It's actually one of the best small caps I've seen. Like out of all the companies that are worth 135 million, this one looks great. If we look at their total revenue kind of blended together, it's up 5%. Last quarter is up triple digits. So nice top line growth, and they have this great net income quarter where they really did net 34 mil. So a bit of leverage, they probably have more debt than the whole market cap. They do. So yeah, they have 200 mil of debt to pay. Whole company is worth 135 mil, and they're doing a little bit of share dilution. So it's an interesting one for sure. That's probably why they're on my watch list. Does the market open at 6? It opens at 8 p.m. my time. So yeah, I'm on the East Coast, New York time. I saw Allison. Oh yeah, Teradyne. I forgot to get to Teradyne. I'm missing out on so many of these names here. Oh yeah, what was QTWO? Did we get to QTWO? I don't think we did. Q2 Holdings. Let's go see. So a forward PE of a 61. So that's expensive, but maybe they're just now getting net income positive. They are. So look at that. If we kind of zoom out, they used to lose money every quarter, but now the direction has just been up and to the right. They really are making good net income. Revenue's up 15%, and they netted. Is that real? Yeah, they really did keep 10 mil in net income. So they're beating on EPS projections, and the EPS projections are phenomenal. So that's actually a fair valuation because they're just getting net income positive. A 61 forward PE, you really got to do like a 2-year out forward PE. The expectations are great. EPS projections are great too. And just the normal earnings before interest looks great. So no complaints here. Look at the free cash flow. They're printing free cash flow too, 40 mil of free cash flow. No dividend. I like this one. Actually, you know what? I'll put them on the watch list. Is there like an interesting one? I do like the growth there. Comcast. Should we do Comcast? And Snowflake. I do want to get to Snowflake. We already did Iron Mountain, but actually we'll look at that one. There's just so many stocks I got to get to. I do want to get back to Iron Mountain. I love that one. The very first stocks in it was one of the first ones I looked at on the stream, Iron Mountain. By the way, I'm streaming on YouTube. My YouTube channel is called Nathan Roberts, in the link to my bio, but you can type into YouTube Nathan Robert, you'll find it. So let's look at Snowflake, and then we'll look at Comcast and ETFs. Hey, what up, Marvin? So here's Snowflake. There's some great news and there's some bad news around this one. Snowflake to acquire AI observability platform Observe for $1 billion. Also, look at that. They're buying a company for $1 billion. I remember that we watched that news. They gapped down on that news exactly. Like the second they announced that acquisition, it went down. I don't know, but I love, here's the great news about them. They have great top line growth. The revenue's up 28%, after grew 28, after grew 38, after grew 85. Like they're on a crazy streak of growth. This is like the real case use for your data. It's like a real AI play right here. They're like second best to Palantir. It's like a mini Palantir. And the expectations are up and to the right. They always beat on expectations. But the bad news is the net income they lose. They are losing 300 to 400 million of net income a quarter. That's a lot of losses. That's what makes me a little uncomfortable with these massive losses. But analysts, this isn't anything new. Analysts are expecting them to still lose like $1 of EPS every quarter for the next couple quarters. So as long as they keep this top line growth, and I like that they're doing an acquisition, but it's hard to really afford to, pay $1 billion for a company, but you're losing, $2 billion or close to that, $2 billion of net income a year. It's hard, but Yeah, this is a real AI beneficiary, but they might be expensive. It's I don't really know what because there is no forward PE. They're not expected to get net income positive anytime soon. So it is expensive, and I maybe like a UiPath or like a Palantir more. Let's see. Uh, I don't know what these sounds about. I don't know which ones to get to. These are all so good. Let me actually do Progressive Corp. I actually want to check this one. What app are you using to check these details? Hey, yeah, actually, this is a brokerage right here where you buy stocks on. If you wanted to get this brokerage, it's in the link tree in my bio, very first link there. But Progressive Corp, this is a great one. They just did a special dividend. I do own this one. I was actually just looking at an insurance ETF. Here's how you can find that. You can actually just scroll down here. It's not IAK, but yeah, look at this insurance ETF right here. I really like insurance companies. They always give you a good return every year in terms of a stock. But I own Progressive. This is the insurance company I own individually. Here's why I like them. If we just look at their personal lines right here, which is most of the revenue, 82% of their total revenue, this is the growth you want to see. It's up 16% year over year. After grew 35, after grew 58, after grew 7. Like they're on an absolute streak of growth. Every year it just hits a new record every quarter. And not just the revenue, but the bottom line. This is their net income every quarter. And this is after tax. They're making 2.5 to 3 billion of net income a quarter. And look at how much that was an increase from the previous year. Like they're making a lot of net income. What's their net margin? 12 to 15% net margins, like growing their margins. So anyway, I really like Progressive. So they're making 2 to 3 billion of net income a quarter. The cash flow is even better. Check that out at the bottom here. What's actual free cash flow here? Yeah, 5 billion of free, 4 to 5 bill of free cash flow a quarter. And if we go to their how much the dividend cost, the dividend only cost $58 million. And why does it say 2.7 billion? Well, every January they do a special dividend, and it was $13 this time. It was crazy. So yeah, they did a $13.50 special dividend. They normally only pay you 10 cents a quarter, but every January, like here's the last January, $4.50 special dividend. There was a 75-cent special dividend. So they're raising their annual special dividend. Like I like that they keep their normal dividend payout ratio super low, but then whenever they want to, they can do these crazy special dividends whenever they're making extra net income, a surplus like they are right now because they're printing net income. And you really look at two different things here. Where's the income statement? Okay, so yeah, you look at their total premiums earned, that's at a record. Total premiums earned at the top here, up 20% year over year. But where's their net investment income? So yeah, this is where you like pocket the difference. That's also done great. Anyway, Progressive's a cool one. I do own that one. I'm totally biased. I am down on that company. Well, when I include the special dividend, I'm kind of close to break even. But anyway, yeah, I do own 4 shares of Progressive right there. Okay. Hey, what up? Nonsense. I appreciate that. Let's do Iron Mountain again. Sorry, I forgot to get to this one. What up, Tommy? And Looney, you know what? Looney will do. Which one should we look at? GLW. When does Progressive do a special dividend? Oh, they already paid out the special dividend. I just got it in my account like a week ago. So yeah, they already got paid the $13 special dividend from Progressive. So here's Iron Mountain. This is a REIT I own in here. The REITs are finally starting to recover. A lot of the interest rate sensitive stuff. Check out them the past week. They've been up and to the right. They've been struggling, from back here, when I was first talking about it. But fundamentals always outshine in the long run, and I think this one will go back to $100 eventually. But let me show you why I like this one. This is a REIT, a triple net lease REIT, and they've been one of the growthiest ones. Like, check out this stock. Like, here's the 2019 or COVID dip. Then ever since then, they've just been up and to the right, and they're finally on a kind of good opportunity to buy in, maybe. So I bought a little bit. They have a 3.9% dividend. That's a great dividend. So no matter what, you're getting 4% of your money back in a dividend every year. And they have a rule where they keep their dividend payout ratio in the mid 60%. They never let it get out of there. If you look at their global data center business, check out the growth. It's up 33%. After grew 20, after grew 27, after grew 13. That's what you want to see. It just hit 200 million for the first time ever. It just hits a new record every quarter, every year. So that's at a record. They also have this corporate and other business. Like, these are great growth rates. 46% year over year after 84% growth. growth. And their main business right here, Global Records, that kind of just grows single digits, but that's great, up 6% after 7, after 8. And these two are the real growth drivers right now. So that's why I think you'll get the 4% dividend yield and then also around 3 to 4% stock price appreciation every year. Dividend payout ratio in the mid 60s. So I do own that one. But yeah, I like Iron Mountain. Should we look at VZ for a dividend play with upside? So Verizon. Actually, I'm glad we talked about this. Well, this stock almost looks like a bond. If we zoom out on Verizon stock is the same price that it was in 1997. So if you bought Verizon in 1997, it's the exact same stock price that it is today. But what you do get every single year, this is what you do, you kind of just buy this to maximize your income. What you have got every year is a 6.7% qualified dividend. So you basically just get your 6.7% dividend. Then you kind of just hope for 1 or 2% stock price appreciation. But it hasn't done that since, I guess, 1997. So anyway, you buy for the 7% dividend. I don't see too much upside in terms of stock price appreciation. It's not just Verizon. I'm not just picking on them. Like, check out AT&T. AT&T stock as well. They're the same prices they were in 1998 as well. Like, that's crazy. So telecom kind of commodity. I don't love Verizon, but Verizon, it's safe 6.8% yield for sure. Is someone saying APP like AppLovin? Let me know if you're talking about AppLovin. Quit day trading. Hey, we're looking at like long-term holds here. That's kind of what we're doing here. Can you look at SHW, please? What's that one? Is that Sherwin-Williams? I think they're a big Dow company. Yeah, they've done great. Kind of interest rate sensitive. They kind of trade with the home builders like a Home Depot because that's what they sell at Home Depot and stuff. We'll look at Teradyne. Cormedics. I like Cormedics too. So yeah, they're at a 31 forward PE. That's not crazy expensive. A 31 forward PE. So yeah, Paint Store Group, Consumer Brands, Performance Coatings Group. So yeah, if we go to their net income bottom line, they make good money every quarter. Easily 500 mil to 800 million of after-tax net income a quarter. The dividend's a 1%, very safe payout ratio. So they raise their dividend every year by a good chunk. So yeah, it might be a slight bit expensive at a 31 forward PE, but they're certainly quality. Their net income hasn't fallen as much as some of the other names. Let's go see how much the dividend cost is. The dividend cost $195 million, and they're making, they made $800 million just this quarter. So that pays for the entire year of dividends. But the cost of the dividend is going down because since they have so much leftover money, check out the top. They're doing massive share buybacks. I love this company, actually. So yeah, net income is up 3.3%, but the net income per share is up by 5.35%. Because they bought back a lot of their own shares. Home Depot is another one I like right now, kind of like a Lowe's, a Home Depot. These are doing pretty good. This is at a 26 forward PE, and they have a 2.44% dividend yield. Not too shabby. So Teradyne, they're really growing their robotics division. Whoa, they're at an all-time high right now. Is there any kind of news around this one? Nope. But anyway, they've done phenomenal. They're expensive. Yeah, a 44 forward PE, but this is one of your real robotics plays where they're like a real robotics company. They have their normal semiconductor business and then, yeah, the robotics business right here. But check out the expectations. The revenue is going to go from 685 to 920 million. That's why the stock has gone up so much. It's pricing in the growth that it's about to have. Same with EPS. EPS is going to nearly double from 59 cents to $1.11. Or $1.11. So the EPS expected here is really good. So the growth is finally going to come back because it looks like the growth has been slow the past 2 quarters. 4.3, -10, but the expectations are great. See what the EBIT is. Yeah, same with that. Yeah, that's great. So anyway, there's Teradyne for you. Okay, what do we want to get to next? Yeah, Sherwin-Williams is a great one. Hey, Nathan, what is going on with OPTX? Oh, wait. Hey, what up, Brandon? We'll get to that one too. I want to get to Cormedics really quickly. This is a small cap that has gone through a lot of issues, Basically, they had this product that gets like this government subsidy and it expires in like 8 months or something. So that's not good. But basically, They sell this product called Defincath. They sold nothing a year ago. They literally had no sales at all whatsoever a year ago. And now they have great revenue, specifically from Defincath. It's 85% of the revenue. It exploded, record revenue, 88 million it did. But there's bad forecasts for an late 2027 numbers. So but they're going to print so much net income. Like, here's the thing, the whole company, this is what's crazy, the whole company is worth 600 million, and the forward PE is a 2.8. So remember that the whole company's worth 600 million. We can see these EPS projections. It's supposed to go from 30 cents to 71 cents. Like, this quarter was $1.26. It was a one-time adjustment. Let's see. Here's how you can do that math. Last quarter, 28 cents of EPS is $20 million. So it's a company worth 600 million that's making a lot of net income, but the forecast is bad. So that's why I actually just bought the slightest bit more of CorMedix, but it's a company that I always say you never want to have this as a meaningful size position just because there's so much risk here. I normally, with these $600 million, very small market cap names, so I'm down 31% on my position. So keep it as a very small position, but maybe have it as a super small size position, but there's some bad future expectations here. But there's for the next year, this year, like, EPS numbers are going to be great. Like, they're going to retain, like, before that goes away, they're still going to make like another 600 million of net income. That's just going to go to their balance sheet. So I do really like them, but keep it as a super small position. What was that one? OPTX, Eric said. This is Syntac Optic. They were up 30%. So it's a very small one as well. 160. Hey, we'll get to Citigroup. My bad. Eventually, I want to get to the newer people stock first there, Nick. My bad. But yeah, they're worth $166 million. So an extremely small market cap. And do they have revenue? They do, but the revenue's down 12% year over year. So they only did 6.9 mil of revenue, and on that they lost $1 million. But the profits are kind of choppy. Like, sometimes they make in one quarter they made 500K, but I mean, the profits are choppy. The revenue's down 12%. Nothing's really blowing me away here. It looks like a momentum swing trade kind of stock. I wouldn't really trust too much money in them, but I got to do more. They're just so tiny. John said WHR. What is this one? Whirlpool. Oh, so this is kind of like a consumer staple play. I know they have like a decent outlook for the next year. They're kind of like a dividend play. Like, you're not buying this to really outperform the tech-heavy S&P 500 because this stock, Whirlpool, is the same price that it was in 2006. But this company makes like those Whirlpool like washing machines and dishwashers, kind of stuff like that. Domestic appliances, major appliances. So let's see what their bottom. So here's the top line. So the revenue's up 1%, but that's after it fell 19% after. So kind of look at the revenue on an annual basis. Like, that's kind of not the trend you want to see. Sales are lower than they were in 2016, way lower. Revenue fell. But if we go to their net income, it looks like they are still they're kind of making profits every quarter. So this excludes that one-time adjustment. It says they lost 390 mil. They didn't actually that quarter, but if we go to what the core business is making, it's down 24% year over year. So the margins are actually falling here. Yeah, gross margins fell 8.5. Net margin, it's a low margin. I don't love this name. I don't think it'll really outperform the S&P 500. It's kind of a dividend trap. A 7.4% yield, but I know they have a decent outlook for this year, but it's not one I'd want to hold for the long run, really. If you're looking for a great staple stock, a better one, in my opinion, also on a dip, if you'd like stocks on a dip, this one's also on a dip right now. Pick that higher quality, in my opinion, PG, Procter & Gamble. This is a great one, and it still has a good yield, a bit of a lower yield, but it's way safer. A 2.91% dividend, so a 3% yield. They slowly raise their dividend every year. They're very diversified as well. Fabric and home care products, baby, feminine, family care products, beauty products, health care products, and they print, and look at their net income. We saw Whirlpool barely making 80 mil a quarter. But this company in after-tax net income makes 3.5 to 4 billion of net income. So they're actually doing some buybacks as well. So Procter & Gamble is probably the high quality pick I'd recommend. I'm from Chicago. Hey, nice, Brandon. Hey, Good to see you. Yeah, we stream every day. If y'all wanted to follow button, we're also like for sure this time going to be streaming at 8 p.m. Yo, try not to spam there. The real yo. If you want to get this platform, it's in the link tree in my bio. The very first link there. There's actually a brokerage where you buy stocks on. Broker called Moomoo. But yeah, link tree in bio. First link there if you want to use my affiliate link. So HDIV, is that like a dividend play? HDIV. Capital Partners Enhanced Covered Call ETF. So yeah, these covered call ETFs always have really high dividends. So yeah, 9.8% dividend yield. What does it own? Let's go see it. So it owns a bunch of other high yielding ETFs. So like a covered call gold ETF, covered called technology max yield maximizer. So yeah, you kind of buy these to maximize your dividend income. It's actually had some really good stock price appreciation. I am surprised. Yeah, that's your covered call play. TPL after the stock split. Yo, that's actually a royalty play. I actually really like TPL. They're expensive though. Let me go over this one. I think you'll like this one. Would you suggest having an S&P in an individual account or keep it in my Roth? You know, it's great for both. Like honestly, it's great for both. I like it even in a normal taxable account because it still will give you 8% plus your money back. Whenever you go to sell it, your choice, you know, either way, whatever you're getting in the S&P is a great idea. So here's TPL. So oil prices have been flat. Like oil, like last month, they were like the lowest prices they were since February 2021 last quarter. But look at this company's net income. It's actually growing. It's up 13%. Their net income has been super stable, very different than like an Exxon Mobil. They're not as heavily exposed to the commodity prices because this company, if we go to their net margin, they have a 60% net margin. You know, not some oil commodity stock that has a low single digit margin because this one actually collects royalties. They basically have like these 200,000 acres of land in Texas, and they basically license it out and collect royalties on the water and the oil that these drillers collect off of the land. So that's how they just print 60% net margin. They make over 100 mil of net income a quarter. And cherry on top is a fortress balance sheet. Literally no debt at all, 500 mil of cash. So pretty good, but their forward PE is a 40. Again, they certainly deserve a high multiple because they're so quality, fortress balance sheet, high margins, but it might be slightly bit expensive. But I that's one of my favorite ones out there. I really like TPL. They also do sometimes like a special dividend. Um, your thoughts on SOXL 3x leverage? So just how math works, you can look at any 3x leverage ETF in history. So I'm not just picking on this one, just how math works. They always spiral more and more down to zero. Well, actually, oh, this is the bull ETF. Oh, actually, I meant whenever you look at the 3x bear ETFs, but actually, yeah, look at this one. This one is the same price that it was in 2021. You know, if you go to the S&P 500, it's well above where it was in 2021, but because of the 3x leverage, whenever there's a down market, it falls by 3x, but it's harder to recover that. So anyway, yeah, this is a trading vehicle right here. I think it's SOXS. What's the 3x down ETF? Yeah, the 3x bear ETF. Well, anyway, yeah, this one's at an all like these always just reverse split more and more down to zero. That's why the original stock price says 18 million because of all the stocks. But anyway, yeah, actually that one's like a trading vehicle, SOXL. It's just like you short term do a call on it or something because there's just so much volatility. That's what you buy to get volatility for a trade. Can you do CX? Let's check out CX right here. And I'm so behind, I do apologize. NAIL. Hey, what up, Dino? And MasterCard. Ooh, hey, we looked at Visa earlier. We have not looked at MasterCard. MasterCard's also great. Reliance Industries. What's the ticker symbol for Reliance? We can check that one out too. Hey, what up, Narc? Good to see you. GTA 6. Ooh, TTWO. We'll look at TTWO stock too. That's a good gaming stock. So here's CX. I don't want to try and pronounce the name there. We'll just say CEMEX. But this stock is the same price that it was in 2005. So this stock has not done too well, but it's done great the past year. Let's go see if we can figure out what happened there. What did they do? From the sale of goods associated to Chemex main activities. Well, what do they do? Let me go over here. Cement ready aggregate. So they literally just sell cement. Oh, so that's kind of interesting there. They sell a bunch, literally the commodity of cement. Yeah, there's kind of like one of their trucks. Oh, S&P Global has a credit rating on them. So anyway, yeah, so they literally ready mix concrete. Let's go look at their revenue. They sell a commodity. What's the net margin they get on this? Let's figure it out. So the net margin is a 6 to 10%. It's a little choppy, but if we go to their net income down here, yeah. Actually, yeah, let's remove the one-time adjustments. Let's look at the operating profit. They're consistently making like 300 to 400 million of after-tax net income a quarter. Um, that's actually surprising. So, yeah, the revenue, it's up 4.7. So there is a bit of growth back to the revenue because if we look at their financials before today, this isn't really great. Revenue's down 5% after it fell 3, but maybe there's a good outlook on U.S. building infrastructure. And the U.S. is only 32% of the revenue. So they basically just sell a commodity of cement that's, always needed for when you're building things, so it's 32% revenue U.S., then Mexico, then all these other countries as well. So that's really interesting. What's the forward metric on this one? A 14 forward PE. That's pretty cheap. A 14 forward PE, but they just sell a commodity. These commodity stocks don't always outperform, same price that it was in 2005. But what was their dividend yield? Let me check that out real quickly. A 0.69% dividend. So they cut their dividend, but it's back now. Okay. TTWO. Let me check out this one real quick. Then we'll get to MasterCard. Remind me, and maybe Vici Properties. That's an interesting Vegas REIT. So Take Two. Yeah, this is the company that owns NBA, GTA 5, Red Dead Redemption. Rockstar Games. And as we know, the GTA 6 is going to come out in a year. So it's, in my opinion, it's all priced in the stock, and I don't love it. It's actually current valuation is pretty. It's expensive, but they're in this unique position where they have this asset. This game they're about to release. That's just whenever they release this game, it's instantly going to bring them in billions of dollars and reoccurring revenue for like the rest of the time. It's supposed to be one of the biggest games of all time when GTA 6 comes out, and they're perfecting the game right now. So anyway, that's kind of why I think it's why. I think all analysts know this at this point, and it's tough risk to reward buying it today, but they're a great company, and I can't wait to see what happens to their revenue because there's so much future growth expected to come whenever they release this game. Hey, Adrian, happy Sunday, everyone. I hope y'all are having a great day. So let's check out this other one right here. MasterCard, what up, Bandit? So MasterCard's a great never sell stock. Even at its current prices, like even though the stock is pretty close to all-time highs, it's not crazy expensive. A 31 forward PE. I think they're more of like an international play than Visa. Yeah, so check this out. The U.S. on MasterCard is only 30% of the total revenue. Other countries are where most of the revenue comes from. It's 70%. But yeah, 31 forward PE, pretty lower. Like its current PE is at 36, forward PE is at 31. That means they're supposed to grow their net income a good chunk. But if we look at their bottom line, MasterCard always easily makes around, record up 20% year over year, like 3 to 4 billion of after-tax net income a quarter. And what is MasterCard doing with 3 to 4 billion of after-tax net income? Well, they pay a dividend, and it only costs 687 million. So what are they doing with? So what are they doing with all their leftover money? Check out the top here. They're doing 2 to 3 billion of share buybacks a quarter. That's the real value here. Like if we go to the net income, it's up 20% year over year, but the net income per share is up 23%. It's up even more because they bought back 3% of the entire company. So that's how shareholder friendly they are. They bought back 3% of the entire company and paying you a 0.5% dividend yield that grows every year faster than inflation. So MasterCard is a great one that should give you 7% of your money back a year, even if you buy it at right now price. Reliance Energies. Yeah, what's the ticker symbol for Reliance Energies? We'll actually check. Google stock, Gemini AI. These are all great. Let's actually do Comcast real quick. This one is a bit of a dilemma because they have this cable business that kind of is just going to decline single digits for the rest of the time. So Comcast is the same price that it was in 2016. So that's a year ago, basically, or a decade ago, which is unfortunate. But they're really cheap. Look at that forward PE, a 7.6 forward PE. They're really cheap. But there's a reason they're really cheap is because they have this basically cable business that's just going to decline single digits for the rest of the time. Is like, like Netflix is a big competitor here. But they have all these other businesses that I like that they're trying to grow, like theme parks, Universal Studios. Yeah, they have a studio business. Theme parks. I like their theme parks, like Legoland, I think is there. in Universal Studios, and I think they're doing some sort of like Nintendo World thing. I don't really remember. But if you go to the dividend, they have a very safe dividend, a 4.6% dividend. That's a very safe, very fair. But it's kind of this slow bleed out of their total revenue that's gonna hurt Comcast in the long run. But they still print money right now. They're easily making 3 to 4 bill of after tax net income a quarter. They had a one-time adjustment last quarter, says they make 11 bill. They didn't actually. Um, the core profits fell 5.5% after it fell 9.5%. So that's why I think that one's a low PE. They're not too terrible though. I like it's not. They're one of the better picks for sure. They really do have a safe 4% dividend, but there's been no stock price appreciation since 2016. Actually, I've been buying a little bit of Disney. Disney's also done really bad. Disney's the same price that it was, back in like 2017 as well. So it's not just Comcast. Disney's been struggling as well. But Disney's is innovating. They have a big streaming business now. Disney Plus, Hulu, and ESPN is all owned by Disney. So pretty interesting there. All right, let's look at some more here. Let's actually do Google. We haven't looked at Google the entire stream. Then we got to get to like Vici and like Fiserv, NatWest. What are some of these? Hey, what up, Rambo? I appreciate that. What's your background? Yeah, I'm definitely not an expert. Don't listen to me. I'm a college student right now. So yeah, actually, I got the tuition due in like 4 days. It's like $1,800, which I won't be investing a lot of new money in the market because of that. But let's check out Google real quickly. Here's why, even though Google is at an all-time high, they're probably going higher, and they're actually cheaper than Amazon if you're paying for growth. Look at the forward PE in the middle here, a 30 forward PE. Like, that's what's crazy. Even though Google's at all-time highs, they're at a 30 forward PE. That's very fair, in my opinion, for this actual ETF in one. I mean, we can see the EPS projections. I mean, they always, look at this, they always every quarter beat like crazy on their EPS, but yeah, it's supposed to go from $2 to $2.52, and that's using these orange numbers. They always beat on the orange numbers as well. But anyway, yeah, they own YouTube, they own Android, they have the Google Cloud, which is growing like crazy. The Google Cloud is the third largest market share behind AWS and Microsoft Azure Cloud. They're acquiring Wiz. They're going to be in the top 10 cybersecurity plays. They're in TPUs, Waymo, quantum chips. And if we just go to Google's net income right here, just simple after-tax net income, what they're keeping, they're easily making on average 25 to 35 billion of after-tax net income a quarter. What is Google doing with all that? Well, they pay a dividend. That's why they're going to be a great dividend growth name. It only costs $2.5 billion. They could pay for their entire year of dividends in just half a quarter. Like, they have so much room to raise their future dividend. It's just a dividend costs so little. They're doing crazy share buybacks. Look at the top here. $11 to $15 billion of share buybacks a quarter. They have the second largest share buyback program of any company on earth, right behind Apple. But they've slowed down the buybacks because Google's investing in Gemini and AI. Because of their cash from investing activities, they're spending 27 billion these 2 quarters, but they made 48 billion in cash from operating activities. It's like, I can't believe how great Google is. And that's why I'm a shareholder of Google. I'm up crazy on Google. I'm up over double, but I wouldn't even consider selling or trimming a single share because it's just such a steal. They're going to raise their dividend so much. Like, they could afford to 4x their dividend right now. They just choose not to, which I like. That's actually kind of the whole theme of this portfolio right here. Buy companies with super low dividend yields that leave themselves so much room to raise their dividend in the future, but they're not doing that right now because they're investing in AI. Like Meta, Carlisle, United Rentals, like they all have pretty low dividend payout ratios. And in this portfolio as well, like Coca-Cola Consolidated, Comfort Systems is a great example. Hey, what up, Steffi says, if you liked the video, hit the like. Hey, thanks so much. Yeah, if you guys wanted the like button, I really would appreciate that. I sell nothing. Please watch out for people impersonating me. I have no course, book. I don't coach. I literally sell nothing. The only way to support me is hit the like button and subscribe to my YouTube channel. I'm streaming on TikTok right now. We got 98 viewers on TikTok and 30 on YouTube. I'm trying to build on my YouTube channel, so if you want to support me, watch the stream from YouTube. It's called Nathan Roberts, also in the link tree in my bio. But we stream every Sunday this exact same time. I haven't missed a single Sunday ever, like for over like a year. We stream every Sunday this exact same time, and we just stream every day. But we're going to be doing another live stream later tonight at 8 p.m. as well. So let's look at Vici. Let's get to another dividend stock here. This is your Vegas play, best Vegas play, but this is a triple net lease REIT. And if we actually If we look at the Vegas numbers right now, they're not good. Like there's an 8% slowdown in like the tourist year over year on Vici, but they're in the best position. So they own the land, the triple net lease under literally all the popular gaming properties in Vegas. They own, y'all seen the Las Vegas Sphere? They own the land under that, under Caesar's Palace, the Venetian, MGM Grand, like these famous properties. They own the land under all these, and it just keeps on going on. There's some other great ones that I forget. The Luxor, that big like black pyramid in Vegas, you know what I'm talking about? They own the land under that. So they are in the best position, but all their top tenants aren't doing too great. But look, yeah, they print money easily every quarter, 500 to 800 mil in net income. Like let's go do a dividend payout ratio. Again, this is a REIT, so they have to by law pay out 90% of their taxable income, but the dividend only costs 450 million. They can afford that every quarter. You really look at this number down here for dividend payout ratio. So yeah, they have a 6.3% dividend yield, but I think one of the reasons Vici is struggling right now, and actually I do think it's good to buy the dip on, but all their top tenants aren't doing too well. Like if like one of their top tenants is MGM Resorts. MGM Resort stock is lower than it was in 2004. What was the other one? Caesar's Palace. That's ticker symbol CZR. This is their top 10. I think 30% of all their revenue just comes from Caesars. And as we can see, their core tenant like Caesars isn't like, I would not individually buy their tenant stock. Like I wouldn't buy Caesars. I wouldn't buy MGM. Caesars is the same price that it was in 2017. What about Las Vegas Sands? That's another big one. Las Vegas Sands, see their tenants just are struggling. Las Vegas Sands is the same price that it was in 2006. So it's unfortunate to see, but Vici is best positioned because what are they going to, if they don't pay their lease, that's the last thing you don't pay. Your doors aren't open. So anyway, Vici's a great one, but I think I understand why they're struggling right now. Hey, watch out for that person in chat there, impersonating. Okay. Oh yeah. Wynn Resorts. Yeah, that's a popular one. I think Wynn's doing a little better. Let's check it out. Wynn Resorts. See, that's so sad. Even Wynn Resorts stock is the same price that it was in 2007. So these just don't really historically do great in the long run. And you'd think the casinos and the stocks would be doing great because the house always wins, but their stocks haven't been winning. The winner is actually Vici Properties, the one who collects the rent every month. Okay. GLW Corning. So this is a big infrastructure play, connectivity, cable solutions play. Let's actually check out if there's any news around this one. It's just like an Amphenol. Actually, if we compare the price of Corning versus Amphenol, they're very similar. And actually, like Amphenol is a much like high quality or pick, and it has a lower dividend yield. But anyway, as we can see, these stocks move very similarly. But anyway, if we go to Corning right here, their forward PE is a 31. Its current PE is a 55, but the forward PE is a 31. There's a lot of EPS growth. So yeah, their optical communications, this is their big growth driver. It's up 33% year over year after it grew 35. And this is all from data center growth. Let me actually see what the EPS projections are. So yeah, so it's actually, well, it's not as great, but it's going to go from 46 cents to 56. So, they're not, the profits have really been fixed over here. So if we go to the revenue's up 20% year over year. So revenue's up 20, but look at this profit. This is the real winner. It's up 95%. So that means their margins are going up. Gross margins are up 10% year over year after they grew 6%. So margins are going up, which is great. There's a little one-time adjustment they had to the net income back here, but they're basically really fixed their margins as this optical communications business is growing. They have some of these other businesses that aren't growing as much, like the display revenue. Look at that. That's actually down 7.5% year over year. And that's their second largest business. They also have specialty metals. That's up 13%. So actually, I like Amphenol as a more pure play. They're a slight bit more expensive at a 34 forward PE, but they're quality. Yeah, actually, hey, this brokerage is telling me, what is this right here? There's a double bottom, rise probabilities at 95% chance. But yeah, Amphenol is another great one. This is the one that provides NVIDIA with their copper cables. And check out the growth. It's up 96% after 32% growth. That's the same optical communications as GLW. They have their harsh environment solutions and their interconnect sensors. That's all the businesses are at a record here. So yeah, Amphenol, GLW, both will be great winners and will continue to do well for, I think, easily the next year. GLW just has a bit of a higher dividend yield, like double the, 1.31% dividend after all the stock price appreciation. They've always had like a higher dividend yield, a bit of a higher payout ratio. So Amphenol's been able to invest more. Check out that must be some crypto. I don't know about that. YouTube agent, what up? And Shannon said ticker symbol BN. Oh, hey, what up? Josh said MD Medline, I think, and Novo Nordisk. Hey, we got to get to Novo Nordisk too. What up, Jam? I want to get to these. My apologies if I'm a little slow here. And AMD too. AMD is a little expensive, but here's BN Brookfield. Oh, Brookfield. This is the asset manager. I know this company. So yeah, Brookfield, they're like an asset management company. So yeah, they're just like a Blackstone, just like a BlackRock. They're in private equity, infrastructure, asset management. How's that doing? Well, I guess that's not doing too well. Renewable power, they own real estate, they own a bunch of different assets. So private equity, obviously, looks like that's, so look at this. This is the weird part. If we look at the revenue's down 8.3 after it fell 15. So the revenue's been on a massive decline, but it's almost like the stock doesn't care. The stock's just at an all-time high. There is no forward PE, but there must be some sort of good news. I mean, yeah, here's their net income. Actually, the profits are good. They're still making, it says like $3 to $4 billion a quarter on the 18 billion. So they still have good margins, but I don't know. I know there's Brookfield, and then there's BAM, Brookfield. Oh, there's Brookfield Asset Management too. There's like two different companies here, and they kind of do this. I don't know. There's BAM, BA. They both own a bunch of assets, and I gotta judge them off their assets. Maybe look at the NAV value of that. I don't know. So is it pre-recorded? This is not pre-recorded. I'm just a little behind on the chat here. My apologies there, S. Yeah. Okay. MU, yeah, let me get to Novo Nordisk, then we'll do Micron and Palantir. Palantir is a beast, but we'll get to them too. So Novo Nordisk actually just got their Wegovy pill on Amazon. You can go on Amazon right now and find it. It's a weight loss pill with tiered pricing. Monthly prices range from $149 to $299 a month. So that's great news. But there is before today, the reason the stock has gone down so much is because they lose their patent in a couple years. So actually, this is good news. China's Supreme Court upholds Novo Nordisk's semaglutide patent, but this patent expires in other countries in like 2026 and 2028 in Europe. So they lose their exclusivity for their main prescription, Ozempic. It's really popular. This is a weight loss company. Diabetes and obesity care revenue is 83% of their total revenue. That's Wegovy and Ozempic. And they just agreed to cut the price, or they did that like a long time ago, way back here. It was on this day. Back here. There was no news. No earnings report, but except they agreed to cut prices like crazy on Ozempic. And so if we go to the revenue grew 10% year over year, but the net income fell by 22. That's a crushing of your net margin. The net margin went from a 38 to a 26. That's a 30% decline in margin. And, gross margins down, gross margins are down 10%, net margins are down 30. So they're never going to be making the same amount of profits as they were, as there's also now increased competition from like Eli Lilly, Zepbound. So that's why I think they're at this, teen multiple, a 15.9 forward PE. I think that's probably, sadly, a fair valuation for losing their exclusivity. And, I think these weight loss prescriptions are going to be so commoditized, or will be as the patents expire, but they won't have the same level of margin again. But I really love it's such a dilemma, because there's also this great Wegovy weight loss pill that's on Amazon. And that's actually, that news, them putting Wegovy on Amazon tanked Hims. So honestly, Amazon is like a mini Hims. Actually Wegovy pills, or the Wegovy injection, used to be on Hims and Hers website, but they freaking removed it from Hims website, and now they go into Amazon. So what's up with that? I feel bad for Hims. So anyway, let's keep going here. Novo Nordisk, they're an interesting one. They're still printing money, but the margins did go down. Sorry if I'm spending a little more time than I want on each stock here. Actually, let's get to IRWD. Let's check this one out. Ironwood Pharmaceuticals, and then we'll check out Micron and Palantir. Okay. So Ironwood, it's a very small one. You want to be careful with these micro caps, but $660 million market cap, only worth 600 mil. So be careful. Let's see what their net income is. So is that real? The crazy part is they really made 40 mil of net income this quarter. They used to, make no money. They used to make no money, but now they're making this crazy net income. Let's see what the EPS projections are. The EPS projections are, well, they're supposed to lose money next quarter, but they make $1.50. Huh? They had a crazy beat this quarter. Like analysts expected 75 mil, they did 122. And if they beat so massively this quarter, they're most likely going to massively beat on these other quarters. So that's a great future outlook. So yeah, when we go to the forward PE on this company, this is actually why if I was a shareholder, I wouldn't trim out of this one a 5 forward PE. So they're actually profitable. That's why out of all the companies worth 660 million, I love this one. I'm actually going to put them on my watch list, because they're actually profitable. If I was going to risk a little bit amount of money on one, I'd do it on this one with that sort of massive beat on revenue. They're super leveraged, they have the same amount of debt as the whole market cap, the whole country. But anyway, that future growth that's really impressive. What app is this? Yeah, hey, or what site? This is actually a brokerage. It's in the link tree in my bio, that very first link there if you want to get it with my affiliate link broker called Moomoo. Yeah, it's a brokerage. If you go and deposit $100, we'll both get some free stocks. I'm going to watch on YouTube. Thank you, Jam Jam. Hey, Jam Jam, what was that stock you said? There was Novo Nordisk. I'm glad we got to that one. And then we'll get to Palantir next. And then you just gained me, hey, in 5, I really appreciate that. So here's Micron. This is your memory shortage play. And the crazy part is, even though the stock is at all-time highs, I think it could literally go up another 30%. It's certainly tough to buy it at right now's valuation. I probably wouldn't buy it. But if I was a shareholder, I would not trim or sell a single share because of these expectations. Literally, I can't believe it. But they're expecting the EPS. There's going to be almost 1,000% EPS growth rate year over year. It's going to go from $1.68 to $9.50. Like just next quarter, it's going to be $8 of EPS, $9 of EPS. Like if we annualize that $9, that $40 of EPS, and look at the stock, it's $345. So that's less than a 10 PE. So that literally is. So when we go to the forward PE, it's an 8.9. Now that's where it starts. This could stretch up to a 12 forward PE, I think. So that's where the 30% increase in stock price kind of math comes from. But 8.9 forward PE still screams to me that this company's cheap. Now, if the memory shortage fixes or whatever, we don't know. But it's only getting worse right now. Look at that. So they made $5.25 billion of real after-tax net income this quarter. That $5.25 billion is the same as $4.60 of EPS. And it's literally going to be $8 next quarter. So anyway, that's kind of my spiel on Micron. And this memory shortage is actually crushing Nintendo stock. I kid you not. It's the reason if we look at Nintendo right here, it's like almost an inverse to Micron. The memory shortage is tanking Nintendo. They're at actually, is there a forward PE? We don't get that. Anyway, let's keep going here. Palantizzle. Okay, yeah, Palantir. This is a great one. Ooh, Snowflake 2 is interesting. They just can't get profitable, sadly. So here's Palantir. This is one of my favorite stocks of all time. I'd love to own Palantir. I really would. And hey, Tico and Josh, I didn't even see that. Hey, Josh, thanks for those dolphins, those gifts there. I really do appreciate that. But yeah, Palantir, I'd love to own this one. They're just really expensive. But the fundamentals justify a super high multiple. They're at a 230 forward PE. I can't pay that, but they've always traded really expensive. And here's why they certainly deserve a high multiple. A lot of the revenue comes from the government. A lot of police stations use Palantir software, the Air Force, the military, even ICE uses that one. So a lot of people don't like this one from an ethical point of view. But look at the government contract revenue growth. The growth rate's growing. The revenue's up 55%. After grew 32, after grew 12. The growth rate's growing on Palantir, which is crazy. And not just on the government side, but also the commercial side. It's up 73% year over year. After grew 27, after grew 10. So the growth, analysts didn't expect that. So they beat on every metric. They beat on revenue. They beat on net income. They beat on EBIT. And they have a fortress balance sheet, no debt whatsoever, completely debt free. Their cash pile just grows every quarter. This is a multi-bagger because the fundamentals are so good. They're like AppLovin as well is another great one. So yeah, Palantir, I'd love to own them just at a cheaper valuation. They're on my watch list. After they released the Minecraft menu, the stock rocketed. Or oh, what stock were we talking about there? What up, Pontus? Um, what's this one? Uh, Grab. You know what? We haven't done Grab all stream. Let's do this. This is an interesting one. So this is a international Uber, and we know that actually when I got this app, hey, if you want to get this app, use my affiliate link, you'll get some free stocks. And one of the free stocks I got was a share of Grab, and I sold it. Shouldn't have done that, but link tree in my bio, very first link there if you want to get this app. But I love this stock. Actually, it's an international Uber. They literally do exactly what Uber does, but in all these international countries. I like that the US and Canada isn't on here. Malaysia, Indonesia, Singapore, Philippines, Thailand. So very diversified. And this is the best part. Uber saw this, and Uber's like, we got to buy them. So Uber's the largest shareholder. 13% of the entire company is owned by Uber. So this was actually genius for Uber because this gives Uber instant international diversification, getting them into all these other countries that's hard for Uber to get in because Grab's already the leader there. They just now are getting net income positive. If you go look at their net income right here, as we can see, it's 10, 20 million. But if we zoom out, they just started making net income. They always used to lose like something. It was really bad back here, like a couple $100 million a quarter, but now they're net income positive every quarter, backed by Uber. We know the commodity of ride sharing and getting stuff delivered to you is universally needed no matter what country you're in. So Grab is the international play. And I also love Uber's stock. Uber's very fair as well. Alex Carb, I bought it at 27 and sold it 100. Should have kept it. Wait, which stock were we talking about? Oh, Palantir maybe? I also used to own Palantir and sold it like an idiot. And I'd be up over like actually, I can pull that up right here. We go to Palantir. This is crazy. This was so long ago. I mean, look at this. I bought, this is so little shares, but I bought like 6 shares at $7.90 and I sold it at $8 and now it's 180. So RIP my Palantir sell right there. But that's the thing. My biggest regrets are selling out of great quality companies like Robinhood right here. Another one. I only have 5 shares left of this one. I used to own over 50. And it made sense. I sold it for a 2 to 3x. I bought, look, here's all my buy orders. I was buying them all down here at, $9, $8, but then I sold 50 at 36 and for a 3x gain, and now it's 115. So that's why I actually created this portfolio right here, my Moomoo account at the top. It's called my buy and never sell portfolio because once I buy a stock in here, I never sell it. I diamond hand these for the long run. I'm not allowed to trim or take any profits. So that's the reason this portfolio is done so good, is because we haven't trimmed. Like most people, like Powell Industries, I'm up 365%, would at least trim a 1 or 2 shares or trim something. But that's the reason we've done so great in the past year. We're up, 95% on a return money weighted average. We did just as bad as we were streaming back here. You can go see the streams. We were doing even worse than the market, but we bought the dip during April, and those have just performed incredibly, specifically Comfort Systems. We bought the dip all in April on this one, and it's just gone crazy. ETF for stocks. I think that you should have the backbone of your portfolio in an ETF like the S&P 500, ticker symbol VOO. Keep the backbone of your portfolio in the S&P, and then play around with a bunch of individual names that love. Like I own Google, McDonald's, Meta, Coca-Cola, Amazon as well. All these great names. And hey, no way. Shout out to Tangrica with that huge gift. That looks so cool. I saw that on my screen. That was so cool. I really appreciate that hand hard gift there. If you got a stock you have to look at, let me know. Monkey D. Luffy said I also sold out a hood. Dang, man. That sucks. What's going to be your next buy for long term? So my most recent purchases that I do plan on holding forever is actually ABBV. I bought AbbVie stock. They have a 3% dividend. It's a prescription kind of healthcare company. Southern Company, this one, it won't be a multi-bagger, but it'll give you 7% of your money back every year. It's a regulated utility. They have a 3.4% dividend, super safe dividend, and you should get on average 3 to 4% stock price appreciation on top of that. Here's one other crazy one. I got CHRW as a U.S. trucking play. I do this all the time. I constantly buy stocks at all-time highs, and it's usually the companies you buy at all-time highs that actually just continue to hit newer and newer all-time highs. So we bought CHRW as a trucking play for the U.S. Okay, let's look at some more stocks here. Progressive, I think, is a really good deal right now. Progressive Corp. So, I think Reddit probably has a little more upside, but I wouldn't buy it at its current price. They're getting in the S&P 500 almost certainly this year. They're the largest non-market cap, not in the Futu. This is a steal of a freaking deal. I was just buying a bunch more shares back here. But yeah, Futu is they're just like Robinhood at a lower valuation, but with more growth than Robinhood. Futu, this stock right here, FUTU, this one we're looking at right here, is literally this app right here, this brokerage publicly traded, and they're doing phenomenal. I like that one too. They're at like an 18 PE. Hey, what up, Plasma and Craig? Good to see y'all. Vish says, hope you're doing well. How about SYM Symbotic? This is the best pure robotics play. Amazon's a slight bit, better, but Amazon's not a pure robotics play. This is the best pure robotics play. Stay away from like a Rich Tech Robotics and like a Serve Robotics. Kraken Robotics, they're not terrible, but I would buy Symbiotic the most. They have over 1,500 registered IP and patents, and they have a huge partnership with Walmart. So Walmart actually loves them so much that they took a stake. Walmart owns 12.3% of all the shares. So their biggest customer is Walmart, helping Walmart out with their warehouse logistics with robots. It looks incredible, like Amazon. The revenue is super crazy. They're doing 500 to 600 million of revenue a quarter. Revenue's up 10% after it grew 44. And let me actually show you their website right here. Again, over 1,500 registered patents. They have these like real working robotics that I wanted to find like a video because I've looked at their presentation. Yeah, they're like this, like kind of on the middle here, like these little, it pulls them off the shelf and moves them. They have the software and everything. Maybe we can watch this video right here. Oh, that's probably going to be really loud. Let me not do that. Anywho, this is the best like pure robotics play in my opinion. There's also a cool, I don't like Kathy Wood, but she has this ARKQ, Autonomous Technology and Robotics ETF. It's actually done great. It's at an all-time high. What does it hold? Teradyne's a great robotics play. Some of these are just air stocks. I'm actually going to remove this. They got Rocket Lab, but it's done great. Okay. Can Mike said, can you look up the stock in AVA? Wait, are you talking about ticker symbol AVAN? I can't find AVAN, Mike. If you give me the ticker symbol or the name of the company, I can find that stock for you. Maybe I typed it in wrong, but let me know what that name is. We can check it out. Wait until it crashed, then you won't have anything. Yeah, let's see. PayPal? Oh, should we look at PayPal stock? That's kind of an unfortunate. They're really cheap though. PayPal's really cheap. Would you wait for a small pullback or Amazon? I would honestly no. I would nibble on. I try to buy the dip every time Amazon does. So honestly, yeah. To buy the bulk of your position, I would wait for a better dip. But if I never owned Amazon, I'd probably, like if I wanted Amazon, it's 5% of my portfolio. I would not make it 5% of my portfolio today at this price, but I would make it 1% to start that position because it's Amazon. 32 forward PE, that's very fair for an Amazon, a 32 forward PE, growing everything. Actually, I want to pull something up really quickly. There's this other, there's these cool KPI metrics we can look at here. I actually want to pull up Amazon really quickly. So you'll love this right here. KPI. So this is crazy right here for Amazon. So here's their online. I'm going to pull it up quarterly. This is a really cool metric right here. So their online store. So they have a bunch of different streams of revenue. Their online store sales are at a record this quarter. Crazy record, 6.7 billion versus 6.1 billion. But look at their physical stores revenue. They're like a mini Walmart, but they have their third-party seller services. That's at a record. Advertising revenue, so they're a mini like Trade Desk, that's at a record this quarter. Their subscription revenue, which, Amazon Prime, Twitch Prime, their subscription revenue is just up and to the right. Every quarter hits a new record. The AWS business is also a huge growth driver. Their cloud business, number one cloud service provider, number one market share. And actually, we can see the AWS operating income. So yeah, this is the actual profits from AWS. It's just up and to the right. Like the margin expansion here really is crazy. So anyway, that's kind of why I love Amazon. There are so many businesses in one, advertising, subscription, cloud, grocery store play. They're like a UPS, UPS, a Walmart, a robotics play, AI play, e-commerce play, a Shopify, like all in one. And if we go to the net income, it's just up and to the right over time. 22 billion net income. Back in 2022, this was a tough buy. Here was the net income you were looking at. It was really choppy, but now the net income has dramatically improved. A lot of it from AWS, and you can't outspend Amazon. You don't want Amazon as your competition. They spend legit 20 to 30 billion a quarter investing in new assets, and it's paying off. It's paying off. I love Amazon. They own so many companies under one. Paul says Waste Management. This is one of the safest stocks out there. If you just buy Waste Management, this is a great example of boring but super great returns. If you buy the stock, you should get 7% of your money back every year. It's kind of seen as AI proof. Whatever happens in the US, we still got to throw away our trash every month, and AI can't really replace that. So they have a great dividend, a 1.5% dividend yield on Waste Management. Bill Gates loved this company. Check this out. The Bill and Melinda Gates Foundation kind of charity thing, they own 7.2% of the entire company. So Bill Gates, so this one, they print net income. They had a one-time adjustment this quarter because they went through this acquisition. They spent 7.7 billion on this medical disposal business, which is really niche and cool. But yeah, they print always 600 to 800 million of after-tax net income every quarter. So yeah, Waste Management's a great safe name. Let's see. ILMN. Let's check out this one. Honeywell, hey, General Mills too. Let's do General Mills. What's up? I just joined. What are we doing today? Hey, what up, Rich? We're just looking at stocks to potentially buy next week. So here's ILMN, Illumina. Yeah, if you got any stocks you want me to look at, let me know in the chat. We're kind of reading what y'all's ticker symbols are. The beginning of the stream was really fun. If you wanted to see the actual original topic of the stream, it's called Best Higher Yielding Dividend Stocks to Buy. Check out the very beginning of the stream. Again, my YouTube channel is called Nathan Robert, Linktree in my bio. You can just type into YouTube Nathan Robert. I'm streaming on there. Stream will be up forever. So here's ILMM, 35 forward PE. Let's see, they had a great earnings report. Yeah, so look at this. They gapped up on earnings day specifically, and they did have good earnings. Check this out. The orange line's what the analysts expected. They expected 1.06. They did 1.08. They beat on revenue. And look at the EBIT beat. They expected 231. The earnings before interest, they did 265. So, yeah, they made great net income every quarter. They hit one-time adjustment, that 700 mil quarter, but they're always making 100 to 250 million of net income every quarter. The sales growth is kind of slow, 0.3 after it fell 3%, but it looks like maybe the growth is finally back, and that's why the stock is kind of reversed back to the uptrend. So yeah, when we zoom out, this looks bad. This stock is the same price that it was in 2014. I can kind of see why. If we look at their annual revenue's been flat, so I don't know. Nothing's blowing me away. I like the net income. They're still making 100, 200 mil in net income a quarter, but they're a little expensive at a 35 forward PE. But I don't know. I got to do more research on this one. I don't know exactly what they do, but doesn't look too shabby. Okay. General Mills. This one's really cheap. They're trading at 10 times EBITDA. They just announced they're doing some cost cutting, which should bring up their margins. The forward PE, just the price to forward net income, is an 11.7. So that's a very cheap valuation. They're very diversified. Check this out. General Mills, they sell snacks, convenient meals, cereal, like Cinnamon Toast Crunch, dough, they own Pillsbury dough. They're in pet food. That's 14% of the revenue, baking mixes. So I like how diversified that they are. But, the whole kind of food environment right now is struggling. Their revenue is down 7.3% year over year. So growth is negative right now, but they still print 400 to 500 mil of after-tax net income a quarter. A little adjustment last quarter. But they announced some cost-cutting efforts. So anyway, they're a cheap company. Actually, I like this one. I'd have it as a small position. I wouldn't have it as a meaningful size position. But I do like this one. The dividend safe. They got a 5.5% dividend yield, and actually they are cheap. And I do like General Mills. I'm still holding on to Microsoft. It's been quite flat. Feels a lot of FOMO. Yo, Microsoft is the best Mag 7 deal right now, in my opinion. They've converted from a hardware to a great software name. The stock literally, this is an AI behemoth. They're trading at 29 times forward PE. For Microsoft, I think that's very fair. And, if we go to their productivity and business solutions, think Office or OneDrive, this software does over 120 billion of annual revenue. And it's so impressive that they just continue to grow this every year. Like in just 2023, it was 60 billion or 63 billion. Now it's 120 billion. It's doubled just since a couple years ago. Anyway, they also have their Azure Cloud, intelligence cloud business. This has been booming. It's also over 100 billion of annual revenue. They're the second largest market share right behind AWS. It's AWS, Microsoft Azure Cloud, then Google Cloud, then Oracle. Yeah, and they literally print 25 to 27 billion of after-tax net income a quarter. They have a super safe dividend. They do share buybacks. They're investing in the future. They're investing in OpenAI. AI toolkit of the future. Every company in one way or another uses Microsoft. So I think it's a great buy, never sell stock. I wouldn't be concerned about its current prices. I'd even maybe look to buy more of that one. Someone said, can we check out BABA? What up, Zarkos? Let's do a little do BABA. And then, APLD and Bank ETF. We'll look for one of those. And Roku has a good partnership with Amazon. We'll check them out. So here's Alibaba right here. This is known as the Chinese Amazon. They own AliExpress, kind of a e-commerce play. It's more of a business to business. Amazon's more of a B2C, business to consumer, but, it's like US businesses are buying stuff from AliExpress in bulk and then they sell it. But anyway, yeah, Alibaba is 55% of their total revenue. And they're also getting into cloud, intelligence or cloud business. It's actually growing very fastly. Oh, we're in Chinese currency. Let's actually convert it from Chinese, yuan to USD. But yeah, the cloud business is booming. It's up 33% year over year on Alibaba. Charlie Munger's last pick. So let's actually see right here. Their net income, their profits did fall a bit this quarter, but it doesn't matter. They're, you average it out. They're making a couple billion of USD after-tax net income a quarter. They just started paying a dividend. They're investing in the cloud. So yeah, they're at a 24 forward PE. That might be fair for a China stock. They don't really ever get much higher valuations just because they're Chinese ADR. But anyway, they're actually a good business. I like the active customers are growing. I like the cloud. I like Alibaba business. So there you go. Probably not the best deal right now, but APLD. So that's actually a company owned by NVIDIA. If we go to the NVIDIA portfolio right here, where is this? NVIDIA is so big, they own some individual stocks. NVIDIA owns CoreWeave as their largest holding, and their second largest holding is APLD. This is a cloud data center hosting business right here. They're at an all-time high because they just reported phenomenal earnings. They just gapped up on great earnings, and they deserve it too. I wonder if we can get a AI recap right here. So let's check out this right here. High performance compute hosting generated 85 mil, accounting for 67 mil. Data center hosting, oh well. Oh, what was that last thing right there? I wanted to read that. Key operational achievements included reaching ready for service status for their Forge project and securing a 15-year, $5 billion lease. Okay, that was, never mind. Anyway, this is the best part right here is this orange number here. The analysts expected them to do 81 mil of revenue this quarter, and they did 126 million. They crushed earnings, and they didn't just beat on revenue, but also EPS. They expected them to lose 12 cents. They only lost 7 cents. They did miss on their EBIT. So maybe this was an adjustment. But anyway, the top line growth is all that matters. This crazy beat is why the stock has gone up so much. So yeah, NVIDIA owns them. Data center hosting. They basically just own a bunch of, data centers and GPUs. I want to get to Netflix too. I want to get back to them. Let me do Roku really quickly. So let's pull up Roku. Then we can do Eisen. Eli Lilly. Eli Lilly's a nice one too. I love Zepbound. So here's Roku right here. TV play, they sell the TVs for a break even, but then they make money on the software. So check this out. We can see their ARPU. This is a great metric. It's their average revenue per user. Their average revenue per user is $41.49 because they have 89.8 million active accounts. Wow, that grew 9 million year over year, over 10%. So that's great. Total streaming hours are 36.5 billion. But anyway, yeah, their platform revenue, yeah, this is growing great, double digits. It hit $1 billion this quarter. It's up 17%. After grew 15, after grew 17, after grew 45. So they're on a nice streak of growth on Roku. Devices, this is their hardware, low margin there. But anyway, it seems the business is recovering. They're expensive because I think they're just now getting net income positive, like for the first time ever. Yeah, look at this. If we zoom out on Roku, they're always, losing a lot of money. But for the first time ever in the past 2 quarters, they made net income. So you really don't look at a forward PE. You do like a multiple year out forward PE or PEG ratio. But yeah, 126 forward PE. I do like Roku and how they're doing. What's this app? Yeah, this is actually a brokerage right here. Broker called Moomoo. If you want to get it with my affiliate link, it's in the link tree in my bio, very first link there. It's free, but if you deposit $100, you'll both get like some free stocks. But yeah, all the tools, analysis tools are all free. You don't even have to make an account or anything. So, Sermon, have I been buying Netflix? No, let's go ahead and do Netflix again. Another one where we can see, we saw very kind of similar to Roku. Roku makes $41 average revenue per user. Well, Netflix, check this out. Average monthly revenue per paying membership, they make $11.69 per month per user. Well, obviously, that's how much, a Netflix subscription cost. But anyway, if we go down here to the bottom line, they print money. Netflix easily makes 2.5 to 3 billion of after-tax net income a quarter. A lot of people would cancel their Netflix subscription last out of all the things. But look at the forward PE. This is why I would start the nibble on Netflix. The forward PE is a 28. For a quality company like Netflix, I think that's very fair. But one of the reasons the stock has had a lot of shenanigans kind of moving down is because they're kind of being outbid right now for Warner Bros. Discovery. They're trying to buy it for $82 billion, but Paramount did a $108 billion acquisition. It's already decreased for the EPS. So the more the price goes up, the more it hurts the EPS. But anyway, Netflix can easily afford to do this acquisition because they don't pay dividends. They don't do any share buybacks. Like they just make $2 to $3 billion a quarter. They can just buy stuff. So anyway, I do like Netflix stock. LST Space. I can't find that one either. Mike, these are weird ticker symbols. I wish I could find that one for you. A bank ETF. Well, here's actually a way to find a bank ETF. You just look up like JP Morgan. We go to JP Morgan, you just go to company and you scroll down and we can see what ETFs own this. Let's see, are any of these called? So the iShares US Financial Services ETF right here. So look at that. It's at an all-time high, this ETF right here. And let's see what it owns. Berkshire Hathaway, JP Morgan, some other names like Visa, MasterCard, Morgan Stanley, Goldman Sachs. So actually, I like this ETF right here. Here's kind of a bank ETF for you. IYG. IYF as well. Actually, that one's on my watch list as well. There's a Vanguard one. Anyway, there you go. Hopefully that was helpful there. Let's do ICE and then Eli. Or this is Intercontinental Exchange, I believe. Or yeah, right here, Intercontinental Exchange. And has anyone heard of Poly Markets? Like Poly Market? This company, ICE, actually just took a 10% stake into Poly Market. So they're kind of getting into the prediction market space, and they're fairly valued, If we look at the forward PE, it's a 28. That's pretty fair. A 28 forward PE. Let's see, fixed income and data services, mortgage, technology, and exchanges. So anyway, if we go to their net income, they are making great money. Here's their after-tax net income. They're easily doing 800 million plus of after-tax net income a quarter, and you get a 1.15% dividend. They raise the dividend every year. So honestly, that's pretty fair. A 28 forward PE for a company that, owns 10% of Poly Market, makes good net income. So actually, I like that one. There was kind of like some single digit growth and like a little bit of a decline to their main business. What is ETR Utilities? Wait, ETR Utilities. Let me know. Are you talking about Entergy? They're kind of a weird name there. Entergy. Yeah, these utilities are doing great right now. From the whole AI data center boom, taking up the grid's electricity so they could raise prices. But yeah, I love the whole utility industry right now. If you look at just ticker symbol VPU, this ETF or that stock, even if you buy it right now, this ETF or these utilities always give you 7% of your money back every year, around 3% in dividends and then 3 to 4% stock price appreciation. We can kind of see the This ETF has a 2.8% dividend yield that raises every year. So honestly, I love VPU. I own a lot of its main holdings too. If we look at its top holdings, its second largest holding, or 7.3, is in Constellation Energy. And then another 6% is in Southern Company. I own a bunch of Constellation Energy. I think that if I was going to pick any individual utility to buy for the growthiest one that's going to do the best in the long run, I would pick CEG, Constellation Energy. They're the number one nuclear play. They own 30% of all the U.S.'s nuclear reactors, number one geothermal play, number one natural gas play, the largest energy producer in the U.S. now, after the Calpine acquisition, which is accretive to the EPS. They have these fully amortized, fully paid off nuclear assets built decades ago that just prints free profit every month now, which is crazy. So anyway, VPU is another just great ETF to get exposure to the whole industry. And I did just buy Southern Company as well. So let's pull up Eli Lilly right here. Eli Lilly, they sell a bunch of different prescriptions, and they are gaining steam with their Zepbound. Let's see. Eli Lilly acquires Ventex Biosciences for $1.2 billion. So they're even getting into other business. Eli Lilly reports positive phase 3 results for Taltz and Zepbound combination. That's good. Eli Lilly partners with Nimbus Therapeutics for $1.3 billion oral obesity treatment. So they're working on a pill as well. Okay, so, and another deal. Eli Lilly partners with Indupro Therapeutics for $950 million oncology deal, kind of getting Johnson & Johnson space. So anyway, this is just a growth behemoth. We go to their revenue right here. It grew 53% year over year. It's already crazy numbers. It was already 11 billion, but they grew it from 11.4 to 17.6. $17 billion. And the best part is, out of that 17 billion, they kept 8.5 billion. They have incredible margins. The revenue continues to climb, and investing a lot into the future as well. They might be a little expensive, at a 37 forward PE, but this is almost like your best prescription play of all time. Like just best healthcare play ever. It's a tough double probably. Yeah, dang, look at that. They're now $1 trillion company. They're worth $1 trillion. So for you to double your money, they have to be worth $2 trillion, but they pay a good dividend, 0.5% yield. I'd put this one on the watch list. They're so great. They sell so many good prescriptions. Thoughts on Meta? Ooh, that's an interesting one. Actually, let's do Meta real quick. Hopefully no one minds there. I bought Eli Lilly at 650, sold it at 1,000. You made a great profit there. So let's do Meta. I do own Meta. Then we'll do C&Q. And what up, Paul says Resolve. We'll check that one out too. Oh, ASTS Space Mobile. We'll do ASTS Space Mobile. I've been getting tickers wrong. I'm kind of blind. Oh, hey, don't worry about it, man. Actually, yeah, we'll do ASTS Space Mobile after this one too. Actually, that one's an interesting one. So here's Meta Platforms. If we head over here, I do own Meta, so I am biased. I got 5 shares of them. I think Meta is at a great price right now. If we look at the forward PE, it's a 22. That for a Meta advertising behemoth, the 22 forward PE is very fair. They own Instagram, WhatsApp, Facebook, and look out this is a crazy metric. Their daily active users are 3.54 billion. So that's crazy daily active users. Everyone, basically half the world is on a Meta app once a day, and their revenue was a record this quarter, 50 billion in revenue. And on that 50 billion, they kept 20 billion. But if we go to their net income this quarter, it says they only made 2.7 billion. It's complete one-time adjustment, so their EPS is only $1. That's why we're looking at the forward PE. It's a 22 forward PE because it was a record profitability Q3 this quarter when you exclude that little one-time adjustment. They did 30 billion in cash from operations. But one thing being questioned is Meta's spend on AI, buying all these NVIDIA chips, trying to train their own Llama LLM, but Llama isn't really too big. So they're spending 20 to 25 billion a quarter. That's all their net income. They're spending a little more than their net income every quarter on these investments. And they now actually, for the first time ever, have a net debt position. So yeah. Hey, what up, Darth? Yeah, hey, maybe we'll get to Micron. Micron's a great one. We already looked at Micron actually twice already, so I probably won't get to that one again. But we got to get to Hood. What up, Amanda? I love Robinhood stock. And red or green, we got to get to XCRS. I think that's another pharmaceutical name. So anyway, Meta's very fair at a 22 forward PE. I love what they're doing with their investments. I don't mind them. Like the Meta Ray-Bans are great. I think all the different companies are going to get into the wearable glasses, like Google glasses, maybe Apple will too. Meta's the first to do it. And they own a big stake in Ray-Ban, yeah, ESLOY. Meta owns a big stake in this company. This is the actual stock, the company that owns Ray-Bans in Oakley. There's a big Meta Ray-Bans partnership, and Meta actually took a big stake into that stock as well. Anyway, I love Meta. Great never sell company. Remco says SYK. Let's try SYK here. And then CNQ, ASTS. We'll check all these out. So Stryker Corp, they're at a little expensive, a 32 forward PE, but there's a lot of growth expected. Like their current PE is a 48, and the current PE is 48, but the forward is a 32. So they're in med-surg and neurotechnology. Hey, that's up 15% year over year, after 16%, after 12%. So that's great. Orthopedics, that's up 4%. So let's check out what they're netting. Easily 600 mil to 800 million of after-tax net income. Yeah, the before tax number was 1.2 billion and they netted 900 mil. So they really do make great net income, and the expectations as well. Let's see what the EPS are. Yeah, they're supposed to get $3.68 of EPS. They have been slightly missing on EPS every quarter, but still a cheap, for the growth. I actually really like that one. There you go, Stryker. So ASTS Space Mobile, there's a lot of future you're paying for right now. They're basically just now getting revenue for the first time ever. Here's the thing. If we go to their projections, this is the main reason why ASTS has gone up so much, in my opinion. It is also kind of just following Rocket Lab, but this was what will sustain the momentum, in my opinion. I wouldn't buy it at its current price, but the revenue, literally, they just got revenue for the first time. They did 14 mil this quarter. It was a record. They always did $1 million of revenue before today. They did 14 million this quarter, but check out what analysts are expecting next quarter. They're expecting 39 million of revenue, and then 34 million. If you annualize that, like going from 700K of revenue to 40 million in a year is crazy. So there's a lot of future growth you're paying for here. That's expected. So that's why if I was a shareholder, I'd probably hold this one, for the next 6 months whilst they do these two earnings reports. But I wouldn't keep this one as a meaningful size position. Because I don't think they're ever really going to get profitable, but they should do good with that top line growth. App name, hey, yeah, this is actually a brokerage. It's an app called Moomoo. If you want to use my affiliate link, it's in the link tree in my bio, very first link there, brokerage where you buy stocks on. So if you get deposit $100, we'll both get some free stocks. But yeah, let's say CNQ. What was this one? Canadian Natural Resources. Okay. Oh, we've looked at this one before. Here's kind of they've done better than Exxon. So look, Exxon, which has done amazing. Exxon is kind of the yellow one, and then there's Canadian Natural Resources. So it's like the Canadian play of Exxon Mobil, or just any like a Canadian Chevron, we'll call it. So let's actually convert the currency from Canadian to USD just to get a better idea here. So yeah, oil sands mining, exploration and production. So let's go to their bottom line right here. We know oil prices have, come down. So these year-over-year comps aren't going to look great, but yeah, they're always making a lot of money. It's like 500 mil to 1.8 billion, somewhere in between every quarter. So they're making great net income. They're at what's the PE? A 16 forward PE. That's usually normal for these commodity stocks. And yeah, 5.2% dividend. That's a great dividend yield. So 5.2% dividend yield for a Canadian kind of Exxon Mobil play. There you go. Let's see here. Oh yeah, Resolve. Let me get to Resolve. Then we got to get to XCRS. Dang, I have to go in 10 minutes exactly. But if you guys wanted the follow button, we stream every day. We've been streaming for 2 hours and 20 minutes, and I really don't even want to leave, but I have to. But we're going to be streaming later tonight at 8 p.m. When the market opens, the market will be open at 8. I might even do a stream before that. I don't know. But anyway, here's Resolve AI. I don't love this one. I think it's just some... They're not even a U.S. company. They are actually listed in London. So they're a London stock. They have 50 employees. And they're basically just now getting some revenue for the first time ever. And they report in halves. They don't report in quarters because they're not U.S. So they report in halves. So they did 6 million for the first half, for the first 6 months of 2025. I guess the expectations are 20 mil in 2 quarters. I don't know. I wish I could give you more thoughts on them, but I don't really have much data to work with here. I guess this is the good news that they're finally having revenue, but they're really leveraged, I guess. Did they just acquire something? I don't know. I'd be real careful with that one. It's supposed to have some news that could push it to all-time highs this week. I don't know about that. Yeah. $1.2 billion company. I wonder if there is any news. Anyway, No fundamentals I see. They're just like they're just now getting some revenue for the first time ever. Nathan, will you buy the Meta Ray-Bans? I have the first generation Meta Ray-Bans. They were on like brand new. They were on like $110. They're a pretty good deal. And I love them. I actually wear them every time I skate because I always wear glasses so I don't get stuff in my eyes, and I wear those now and I can take cool videos. PTC, what's PTC? Um, this is a 29 PE company. They're worth $20 billion. They had a little gap down on earnings. So they reported earnings and fell. Let's see if we can figure out what happened there. So they beat on revenue, they beat on net income, and they beat on EBIT. So it was a triple beat quarter, a massive triple beat quarter. But they must have gave bad guidance. So that's weird, huh? So the revenue, look at that. That's great growth. The revenue's up 42. The net income's up 175. So they're growing net margins. They had a 40% net margin in the most recent quarter, and that was real too. Like this is the after-tax net income. It was 350 million. The before-tax number was 445. So they really did make this crazy net income quarter. I don't know what they're deleveraging the balance sheet too. The fundamentals are phenomenal here. But I don't know, did they give bad guidance? That might be what it was. Product life cycle management, computer-aided design, huh? Where does the revenue come from? So the US is 47% of the revenue. I like the fundamentals. So 29 forward PE on this guy. So yeah, that's probably fair. 29 forward PE. ITA. What is ITA? iShares US Aerospace and Defense ETF. So yeah, actually this industry is booming right now. If you're like, I want exposure to defense and aerospace, but I don't know which individual stock to buy, well, you could buy this ETF right here. Or, put it on your watch list, and the next time there's a dip in the whole aerospace and defense industry, you could buy this one. But yeah, if we go to their top holdings here, it probably owns Raytheon. Yeah, Raytheon and GE Aerospace. I love that those are the top two holdings. Then they got some other ones like a Lockheed Martin and Axon. I love that Axon's in here. Northrop Grumman. I love a lot of these names. I don't love Boeing, but it's market cap weighted. So anyway, ITA, there's your aerospace and defense ETF, and it's obviously booming right now because of the whole war fears and stuff like that. So, I'll actually put them on the watch list. Sony stock, Sony, the Sony PlayStation, Sony Mute. Oh my goodness. Okay. They're making me fill out a captcha real quick. We're back. All right. Sony, this is like an ETF in one right here. If we look at where anyway, unit of key, PlayStation sales. They sold 3.9 million PlayStations the most recent quarter. They also have the PlayStation Store where whenever you buy a game on the PlayStation online store, they keep 30% of the transaction. But game and networking services, so the PlayStation ecosystem, that's 35% of all their revenue. Then they're in imaging and sensing solutions, entertainment and technology, music. They have a bunch of popular people signed to them. Dang, the music revenue is at a record, up 18% after 14, making a lot of money off Spotify. And then pictures as well. So Sony Pictures. So they're in a lot of different industries. If we go to their bottom line, they're easily making 1.4 to 2.5 billion of net income a quarter. They make great money and they're not expensive. That's the thing. Here's why Sony's probably going to keep on going higher. The forward PE is a 20. So the stock is on a decline as well right now, maybe from memory prices. I don't know. But Sony's a great one. They're a Japanese company. NatWest. Let me go quick here with these last ones. I typed it in wrong. NatWest. NWG. Okay, so this is like a natural gas play. And look at that. They're at an all-time high right now. So, and they probably pay a good dividend. So let's see what the dividend is. Yeah, you get a 3.85% dividend. It reminds me like a Williams. So, safe dividend, commercial and institutional. Oh, so this isn't, NatWest isn't even like a natural gas. I'm stupid. Commercial and institutional bank. So retail bank, private bank. That's what they're actually in. So yeah, they make great net income. And this is in US. Oh, actually, no, this is in British pounds. So we'll convert it from British pounds to USD. this is in USD, they're easily making 1.6 to 2 billion of net income, and it's just growing. It's up 35% after it grew 47. So I can totally understand why this stock is at an all-time high. Yeah, this is a bank right here, and you get a 3.85% dividend even if you buy the stock right now. And they made 2.26 bill. Let's go see how much the 3% dividend cost. Oh, we can't because it's a British pound company. Anyway, that's your international bank. All the banks are doing good. If you just look at a boring American bank like a JP Morgan, it's also, check that out, at an all-time high. So this whole industry is like doing amazing. PCG, what's this one? PG&E Corp. $34 billion company at a 10 PE. Dang, this stock is the same price that it was in 2001. So you bought the stock in 2001. It's the same price that it is today. What does this company do? PG&E, electricity and natural gas to customers. Okay, so like a utility, but and in California utility. Here's their net income. They're easily making 600 mil to 800 mil of net income a quarter. So great net income. They had to cut their dividend for some reason, but they're making great net income. So that's why I can't really complain here. I just don't know what's holding back the stock. Maybe I really don't know. Did something happen? Did they get blamed for burning down a power line? Or I don't know. Maybe some sort of liability. Let me see something real quickly. Okay. All right. We can look at like one or two more, then I gotta go. Hey, what up, Vishus and Brian Paul? Shout out to the member. If I buy Verizon, do I qualify for the dividend tomorrow? I don't think so, or I don't know if it's settled money. I think, but if it's not settled, if you don't get the shares settled, you might not. And hey, thanks, Looney. I appreciate that. So you actually have to go right now. Let me just give a quick portfolio update. Let me be quick here. This is by the way, I'm going to be streaming at 8 p.m. Like not as a joke this time, but like for real. We're going to be doing another stream at 8 p.m., maybe a little earlier, like 7:30, which is in exactly 6 hours from now. So we'll be live in exactly 6 hours when the market opens at 8 p.m. But yeah, here's my Moomoo portfolio. It's known as our buy, never sell account, where once we buy a stock in here, we never sell it. These are all the stocks that we've chosen so far. I've been buying a little bit more of Coca-Cola Consolidated on the dip. I've been trying to buy more Amphenol. I just bought another share of Amazon, and they've just been up ever since. So Amazon's great. We also have our Robinhood portfolio. This is known as our dividend-only account. We're actually doing crazy. We're up 4.4% year to date, up 18% the past year. Every stock in here pays a dividend, but most of these, as you can tell, are like dividend growth companies, like Meta, Google, CEG. But these are all the ones I want because they give crazy stock price appreciation. It makes up for the low dividend. We also have a Roth IRA, just a tax-free retirement account. These are all the stocks that we own in here. Cormedix hasn't done too well. Innodata's done great though. Weeble's done decent. I'm actually be looking to buy a little bit more Weeble. But finally, we have our Weeble account right here, which is known as kind of like our risk-on portfolio. I kind of just do whatever I want. Uh-oh. Well, good thing the Wi-Fi just went out as the stream's ending. My Wi-Fi is really buffering right now. Well, perfect time. And anyway, I really got to go. But if you want to support me, there's only one way to support me. It's in the link tree in my bio, very first link. It's my YouTube channel. Please, or you can just type into YouTube, Nathan Robert. The very beginning of the stream is really good. We did crazy in-depth research on some great high-yielding dividend names I think you should check out, like GSL, Southern Company is a good one. Progressive, they do special dividends. We went over in depth a lot of those. I think they're at great buys. Even right now, even though the market's at all-time highs, those are good buys. But anyway, here's our Weeble portfolio. I got to go. Hope you guys have a great rest of your day. Please subscribe to my YouTube channel called Nathan Robert. And what app? Oh, this app's in the link tree in my bio. Very first link there. Broker called Moomoo. Thank you to everyone so much. I'm going to be back in exactly 6 hours. See you all super soon. Thank you all, everyone, being here. Yeah, I know it's me that's lagging. Marks, Vish, Looney, Header. Thanks for, hey, what up, Header? I'm glad Iron Mountain's doing good.